Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today, we are going to crack open a deceptively simple yet, profoundly powerful investing philosophy from a true financial legend. And we're going to find out why the big secret to success might just be hiding in a bagel and a haystack.
Okay, but first, let's just start with a feeling I think we've all had. You know that feeling when you look at the world of finance? All the jargon, the crazy charts, the so-called gurus, it's just overwhelming, right? It almost feels like it's designed to make you feel like you need some kind of expert just to get by.
Well, for more than 50 years, one man dedicated his entire life to just cutting right through all that complexity. John C. Bogle, the founder of Vanguard. And look, he wasn't just some financial innovator. He was a genuine revolutionary. He fought to give every single one of us, the small investors, a fair shake.
So, how do most of us get it wrong? Well, Bogle saw that almost all of us fall into one of two common traps, and he came up with a couple of brilliant, super down-to-earth analogies to describe these losing games that Wall Street kind of encourages us to play.
So, take a second and ask yourself, which one of these games are you playing? Are you chasing the donut? Going for that sugar rush of trying to time the market's crazy emotional swings? Or are you searching for the needle, that almost impossible quest to find that one genius fund manager who's going to beat everybody else year after year?
Let's dive a little deeper into this whole donut idea. The key thing to get here is that this has nothing to do with how well the actual businesses are doing. Nope. It's pure market emotion. It's the collective hope and fear that makes prices swing all over the place. It's that super tempting sugar rush of speculation. But as Bogle argued, it's ultimately just empty calories.
And what about searching for that needle in the haystack? It feels like the smart thing to do, doesn't it? Of course we want an expert on our side. But here's the kicker. What Bogle proved, with decades of cold hard data, is that your odds of picking a long-term winner in advance are just stunningly low. It's pretty much a game that's rigged for you to lose.
Okay, so if chasing donuts and searching for needles are just losing strategies, then what's the alternative? Well, this is where it gets good. Bogle didn't just point out the problem, he gave us an elegant, powerful, and, honestly, a radically simple solution.
And here it is. This slide is really the heart of it all. Bogle said, forget the donut, eat the bagel. The bagel? Now this is the real nutritious stuff. This is the actual return you get from the stock market, made up of two real things: the profits businesses make, that's earnings growth, and the cash they give back to you as dividends. This is all substance, zero hype.
So his first piece of advice? Just stop. Stop playing that impossible game. That endless search for the one genius manager. It's expensive, it's a huge waste of time, and you're almost certainly going to fail. So instead of driving yourself crazy looking for that one single needle, Bogle's legendary advice was just breathtakingly simple. Just buy the whole haystack. That's it. Own a tiny piece of every major company out there through a low-cost index fund, and you guarantee you get your fair share of the market's entire bagel of real returns. And look, this wasn't just some wacky fringe theory. This strategy is so powerful, so incredibly logical, that it got the full-throated endorsement of, just the most successful investor of our time, Warren Buffett. He has said it again and again. For most of us, this is the way to go. So you're probably wondering, why? Why is this simple strategy so incredibly effective? Well, it all comes down to what might be Bogle's greatest insight of all: identifying the single most destructive and usually invisible force that's working against you. We all worry about the big, scary stuff, right? A huge market crash, picking that one stock that just tanks. And yeah, those are risks. But Bogle argued the real killer of your wealth is way more subtle. It's relentless and is chipping away at your money every single day. He gave it a name: the Tyranny of Compounding Costs. And it's just simple, brutal math. Every single dollar you pay in fees is a dollar that isn't working for you, that isn't compounding for you. And over a lifetime of investing, this tyranny can literally eat up more than half of your potential money.
Okay, just look at this chart. This makes the damage absolutely crystal clear. See that top line? That's $10,000 in a simple, low-cost S&P 500 index. Over 50 years, it grows to almost $5.8 million.
Now look at the bottom line. That's the same investment in your average fund, getting eaten away by fees. It only grew to about 2.5 million. Think about that. More than half of your potential return was just gone, eaten by costs. That is the tyranny of compounding costs right there in black and white.
And here they are. These are the culprits. You see, it's not usually one giant fee that gets you. It's death by 1,000 cuts. You've got management fees, advisory fees, sales commissions, the hidden costs from funds that trade all the time, and of course, taxes. They all add up, and they create that enormous gap between what the market earns and what you actually get to keep.
But look, Bogle's message isn't one of despair. Not at all. It's actually a message of empowerment. His whole philosophy is about giving you a simple, powerful toolkit. It's about shifting your focus away from all the stuff you can't predict and onto the few crucial things you can absolutely control. And this is where it all clicks. This is why his philosophy is so liberating. Look, you can't control what the market's going to give you. You can't just wish it to go up. But you have total control over 3 other critical factors: risk, time, and cost. And let me tell you, focusing on those 3 things, that's where the entire game is won or lost.
So here it is. Here's your toolkit. It's the simple. 1, control your risk. How? Diversify like crazy. Just own the whole haystack. 2, control time. Be an investor for the long haul, not some short-term trader. You've got to let compounding work for you. And 3, control your costs. Be absolutely relentless about finding the lowest cost funds you possibly can.
And this is the really beautiful part. It's the flip side of Bogle's big warning. Because when you defeat the tyranny of compounding costs, you get to unleash its incredible magical opposite, the magic of compounding rewards.
Just look at what happens over time. This chart shows you the prize at the end of the road. Over 40 years, what looks like just a small difference in how much you earn each year, it ends up creating a massively, exponentially bigger result. This is why time is your single greatest ally as an investor. Seriously, your main job is just to be patient and get out of its way.
So when you strip it all away, all the noise, all the hype, all the crazy complexity, John Bogle's entire life's work really just boils down to a few core common sense ideas. And you know what? They triumph over everything else.
So let's just recap the core lessons here. It really all boils down to this. 1, eat the bagel, not the donut. Focus on the real value of businesses. 2, buy the haystack. Just own the whole market, simply and cheaply. 3, defeat the tyranny of costs. They are the enemy, so minimize them like your life depends on it. And finally, 4, pour all your energy into the only things you can actually control: risk, time, and cost.
And maybe, in the end, Bogle's most profound lesson is a paradox. You know, the financial world is absolutely desperate to sell you secrets, to sell you shortcuts, to sell you complexity. But true, lasting success, it's found in just embracing the simple, disciplined, and powerful common sense that he fought for his entire life.
Hey, welcome to The Explainer. Today, we're going to dive into a truly classic investing lesson from Vanguard founder John B. Bogle, and we're going to do it using a really simple but honestly a super powerful metaphor: baked goods. Okay, I know what you're probably thinking. Baked goods? What on earth does that have to do with my portfolio? Well, it might sound a little strange at first, but this analogy, which was actually inspired by an essay from writer William Safire, perfectly breaks down the forces that are driving your investment returns. For Bogle, this wasn't just some clever comparison. It was a really profound message about the very character of the market and what it takes to build a successful investing philosophy. So where does this all come from? Well, it all kicks off with this observation from Safire. He saw this fundamental difference in character between 2 breakfast staples that, while they might be similar in shape, they are worlds apart in pretty much everything else. So, on one hand, you've got the bagel. Think about it. It's serious. It's nutritious. Safire even called it hard-boiled. It's all about substance, right? And then you've got the donut. It's fun, it's sweet, it's, let's be honest, fattening. It's that tempting, sugary rush of speculation. Okay, so how in the world does this apply to the stock market? Well, this is where Bogle's genius comes in. He basically said, look, underneath all the noise and complexity, your total stock market return is made up of just 2 things: the market's bagel and its donut. First up, let's talk about the bagel. Bogle calls this the investment return. And this is the real deal. It's the nutritious, crusty, hard-boiled reality of how businesses actually work. It's made of two simple things: the actual earnings that companies generate and the dividends they decide to pay out to their shareholders. This part is all about the real, productive, long-term growth of the economy. And then you have the donut. This is what he called speculative return. And here's the key thing. This has nothing to do with how well a company is actually doing. It is all about emotion. It's about the emotional swings of public opinion, captured by something called the PE ratio, which just measures how much investors are willing to pay for each dollar of a company's earnings. And that price, well, it can swing wildly, from the sourness of pessimism all the way to the sugary sweetness of pure optimism.
All right, let's look at some real numbers to see this in action. Take the huge bull market of the 80s and 90s. The fundamental bagel, the actual business performance, it delivered a really solid 10.4% return. But the donut of pure speculation, it added a massive 7.3% boost on top of that, just because the price investors were willing to pay for earnings more than quadrupled during that time.
In this chart, this just perfectly shows you the power of the donut. It's kind of wild, actually. In the 1970s, the market returned a pretty weak 5.8%. But here's the crazy part. The fundamental bagel, the actual business performance, was stronger back then at 13.3%. The problem was a hugely negative donut because investor sentiment just collapsed. Then the exact opposite happened in the 80s and 90s, where a less nutritious bagel got supercharged by the sweetest donut the market had ever seen.
So what's the big takeaway here? It's this, and it's so important. That massive boom we saw, it wasn't really because companies were suddenly doing 3 times better. Nope. It was almost all emotion. It was a huge shift in public opinion. The sweet, airy donut was completely overpowering the substantial bagel.
All right, so we've got the market's bagel and its donut. But how does that actually affect our investment choices? Well, let's step into the world of mutual funds. And you can think of it like a giant bakery where you're faced with literally thousands of options, and every single one is promising the best recipe for success. And Bogle's argument was pretty blunt. He said the vast majority of mutual funds out there are sold as donuts. They look so tempting, right? They're fun, they're sweet, and they're advertised with these chocolate-covered promises of outperforming the market and making you rich quick. But here's the catch. That sweetness comes with a really high price tag. See, the whole game of trying to find these sweet returns leads to all these heavy costs that just chew away at what you actually get to keep. You get hit with sales charges, high management fees, and this frantic trading. An average fund turns over 90% of its portfolio every single year, and that racks up hidden transaction costs and huge tax bills. All of it creates a massive drag on your performance. So you start to realize that trying to pick one of those winning donut funds, one that can actually overcome all those costs, it's like trying to find a needle in a haystack. And Bogle's response to that was just radically simple. He said, forget the needle, just buy the whole haystack. And that, right there, is the index fund. It is the ultimate bagel. It's simple, it's tough, it's stripped of all that sugary nonsense. See, it doesn't promise to beat the market, it just promises to be the market. It's designed to give you the market's fundamental return with the most diversification, the lowest possible cost, and the best tax efficiency. Okay, this brings us to what might be the most important part of this whole story, the actual financial impact of all this, the real-world cost of choosing a donut over a bagel. And honestly, the numbers here are staggering. Okay, get ready for this. Over the 15 years leading up to 1999, if you had put just $10,000 into the average donut equity fund, you would have ended up with $43,000 less than if you just bought the simple bagel index fund. I mean, just let that sink in for a second. $43,000. So let's look at the whole picture here. During one of the best market runs in history, the average donut fund turned that 10 grand into 57,000. And hey, people were probably thrilled with that, but they had no idea what they were leaving on the table. Because that same 10 grand in a boring, simple bagel index fund would have grown to $100,000. The bagel almost doubled the donut's reward. So why? Why was the gap so huge? Let's break it down, because this is the whole ballgame right here. If you look at the average donut fund, all those costs we talked about, the sales commissions, the high expenses, the crazy high trading costs, and then the taxes on all that trading, they literally devoured more than half of the return. Think about that. The financial industry took a bigger slice of your pie than you did. You, the investor, were left with just 48%. Okay, now take a look at the Bagel Index Fund. It's a completely different story. Because it's so low cost and it doesn't trade all the time, the costs are tiny. No sales commissions, no big transaction fees. Really, the only bites out of the return are a tiny expense ratio and much lower taxes. And the result? You, the investor, kept a massive 87% of the total return. The difference is just, it's night and day. So after all that, what's the big lesson we should take away? For Bogle, it all comes down to a pretty simple choice, really. It's a choice about character, about authenticity, and about having long-term discipline. And he comes back to that quote from Sapphire, but this time as a warning. Let donuts be donuts, let bagels be bagels. The point is, you can't sacrifice your core principles. A bagel's strength is its simplicity, its tasty toughness. The moment you try to make it softer and sweeter to please everyone, like a blueberry bagel, you just end up with a stale donut. You lose the very character that made it great in the first place. And so he leaves us with these 3 key lessons, and they apply just as much to investing as they do to running a business. First, never forget why you're successful. Focus on that tough substance, not the sugary trend of the moment. Second, when you've got a good thing going, don't get complacent. Stay disciplined. And third, and this is maybe the most important, stay true to yourself. Be authentic to your core principles, even when everyone else is chasing the next big fad. And that really leaves us with one last crucial question to ask ourselves. It's time to take a hard look at your own portfolio. I mean, really look at it. When you strip away all the marketing, all the fancy names, all the promises of sweet returns, what is actually on your plate? Is your financial future being built on the solid, nutritious substance of the bagel, or on the tempting but incredibly costly sweetness of the donut? Because the answer to that question, well, it could make all the difference in the world. In the world of investing, there's this epic battle happening every single day. And no, it's not stocks versus bonds or anything like that. It's a much deeper fight, complexity versus simplicity. And today we're going to figure out which one of these 2 paths is actually going to make you wealthy. All right, here's how we're going to break it down. First, we'll get a handle on what these 2, cultures of investing really are. Then, and this is the fun part, we're going to see what happens when complexity goes up against the cold, hard data. After that, we'll explore the simple alternative, understand the 3 critical dimensions that make it so darn powerful, and finally, we'll lay out a super practical plan you can use for your own money. So let's really set the stage here. On one side, you have an entire industry, a massive machine, built on this one really seductive promise, that if you just have the right guru, or the right secret, or the right complex strategy, you can outsmart everybody else and beat the market. It sounds amazing, right? But the real question is, does it actually work? And this, right here, this slide just nails it. You've got the culture of complexity on one side. It's all about gurus, secret formulas, and big promises. And on the other side, the culture of simplicity. It's built on stuff that sounds almost, boring. Discipline, common sense, realistic expectations. One is a flashy sales pitch. The other is a life philosophy. Which one do you think really builds lasting wealth? Look, a good story is great, but stories don't fund your retirement. So let's put this whole culture of complexity under the microscope. We're going to dig into the evidence, and I mean really dig in, to see if this world of gurus and secret strategies actually delivers the goods. So how are we going to test this? Well, we're going to look at 5 different groups who are the absolute poster children for complexity. We're talking active fund managers, investment newsletters, elite advisors handpicked by the New York Times, Morningstar's Managers of the Year, and, oh yeah, the granddaddy of them all, funds of funds. Let's see if all that brainpower pays off. First up, the pros, the active fund managers. These are the folks who get paid the big bucks to sit in front of 6 screens all day, analyzing companies, picking stocks, and making trades. You'd think with all that expertise, all that effort, they'd have no problem beating a simple market average, right? Well, the numbers are just staggering. Look at this. The market, just a simple index, turned 10 grand into over $100,000. The average expert fund, just over 70,000. That means the fund industry basically siphoned off over 40% of the potential gains. They got rich and their investors paid for it. Okay, so what if you add another layer of complexity? What if you pay an expert newsletter to pick the expert fund managers for you? I mean, that's got to be the secret sauce, right? It gets even worse. The average newsletter delivered less than half the return of the market. We're talking about a $22,000 difference on a $10,000 investment. Just stop and think about that. That's a car, a down payment, a college fund, gone. The gurus got their subscription fees, but their readers paid a heavy price. Okay, but what about the superstars? I mean, the real A-listers, the ones picked by the New York Times, the ones crowned Manager of the Year. These are the legends, the financial wizards. Surely they can beat the market, can't they? And the data just shouts, nope. It turns out after these managers get their fancy awards, they deliver on average only about 2/3 of what the market does. In fact, get this, not a single one of the managers of the year managed to beat the S&P 500 index. That's just a basket of big companies in the years after they won. It proves that past performance is a fantastic way to sell magazines, but a terrible way to pick your investments. And now for the grand finale of complexity, the main event, the fund of funds. The sales pitch is brilliant, you have to admit it. They say, hey, picking winning fund managers is tough, so pay us a big fee and our experts will pick the best experts for you. It is literally a financial turducken of fees and complexity. And the result is an absolute train wreck. These things deliver just 63% of the market's return. They didn't just fail to beat the market, they couldn't even keep up with the average fund manager we talked about earlier. It's truly a masterclass in how to pay more to get less. So the evidence is overwhelming. Complexity is a trap. The gurus, the secret systems, the fancy strategies, it seems like they're all designed to do one thing, separate you from your money. So if that's the wrong way, what's the right way? What actually works? You know, the legendary investor Charles Munger said it perfectly. He basically compared the financial industry to a casino, and the people running it are the croupiers. They're all taking a cut, and those cuts add up. Think about it. A 3% fee doesn't sound like much, but if the market only returns 5%, that means they're taking 60% of your profits. The house always wins. And his partner, Warren Buffett, gave us the beautifully simple solution. He said, stop playing their game. Stop trying to find that one magic needle in the haystack. Instead, just buy the whole haystack. Own the entire market through a super low-cost index fund. If you do that, you are mathematically guaranteed to beat most of those so-called experts over time. Now, we've seen how badly complexity fails over a few years. But what happens over the long haul? What happens when you put complexity head-to-head with simplicity over an entire 50-year investing lifetime? I gotta tell you, the result is absolutely mind-blowing. This one chart tells the entire story. The difference here is life-changing. A simple, boring index fund turned 10 grand into more than $5.7 million. The complex, expert-driven approach, less than half that. That's not just a rounding error. That is the difference between living the retirement of your dreams and just getting by. Simplicity wins, period. Okay, so the results are undeniable. But why? Why is simplicity so much more powerful? To really get that, we need to look at investing in a slightly different way, through 3 key dimensions. And they're all shaped by the 4th dimension, time. Now, the first 2 dimensions are probably familiar to you. First, you've got reward. The longer you invest, the more your money just snowballs on itself through compounding. Then you have risk. The longer your time horizon, the more those scary ups and downs get smoothed out. Time is your friend here. But it's this 3rd dimension that is the real game changer. And here it is. This is the secret killer of wealth. See, just like time compounds your returns for good, it also compounds your costs for evil. It's the tyranny of compounding costs. A seemingly tiny 2% fee might not sound like much year to year, but over 40 years, that little fee can devour more than half of your potential return. Let me say that again. The fund industry can end up with more of your money than you do, and they took 0 risks to get it. So, we have seen the evidence. We understand the why behind it. Now, it's time to talk about the how. How can you put all this powerful knowledge to work for yourself? Let's build a simple, bulletproof plan for your money right now. And the answer is incredibly simple. You divide and conquer. You set up 2 accounts. The first one, call it your funny money account. Put no more than 5% of your total assets in here. Go ahead, have fun with it. Chase a hot stock tip. Try to time the market. But the other 95% or more, that's your serious money. That money is for your future, for your family, for your dreams. And that money belongs in simple, boring, low-cost index funds. So there it is. The case for complexity is built on stories, on hope, and on slick marketing. The case for simplicity, it's built on cold, hard arithmetic and decades of proof. Complexity sells you a dream. Simplicity actually delivers the results. So the choice is yours, really. Are you going to keep playing their game, or are you going to start winning your own? So when you invest, are you always on the hunt for that one amazing stock, that one fund you think is going to make you rich? That's what we call the needle. But what if there's a better way? What if instead of spending all your time searching for that tiny needle, you just bought the entire haystack? Today, we're going to break down one of the most powerful ideas in personal finance. And honestly, it might just change how you think about your money forever. You know, this whole idea really starts with a piece of advice that's over 400 years old. A warning against a pointless search. We've all heard this phrase before, right? But what in the world does looking for a needle in a haystack have to do with your 401k? Well, as it turns out, pretty much everything. I mean, think about it. We spend so many hours glued to financial news. We read countless articles, all in an effort to find that one hot stock or that one genius fund manager who's got it all figured out. We're all searching for the needle. But what if this entire hunt isn't just difficult? What if it's fundamentally the wrong game to be playing from the very start? So here's our game plan for today. First, we're going to tackle the biggest enemy for most investors. And spoiler alert, it's our own emotions. Then we'll dig into the cold, hard data on what your chances of actually winning this game really are. We'll uncover this hidden villain that trips up even the pros. And then we'll reveal the simple, almost boring solution that just keeps winning. And trust me, you are going to want to stick around to see the numbers on how much money is actually at stake here. All right, let's dive in. First things first. You know, the biggest hurdle in investing isn't really the stock market. It's the person staring back at us in the mirror. It's this constant battle, this tug of war between our rational brain, which knows we should just be patient, and our emotional gut, which is screaming, sell when things get scary, or buy when everyone else is getting greedy. Let's just rewind to 1987 for a perfect example of this. So leading up to October, the market was absolutely soaring. Everyone was euphoric, and investors threw $25 billion into the market. Then, bam, Black Monday hits, and the market just plunges. Now, with stocks on a massive 35% discount, what did people do? They panicked. They pulled $4 billion out of the market. They did the one thing you are always told never to do. They bought high, and they sold low. And that right there, that's the core conflict for all of us. Our logical brain totally gets that markets go up over the long term, but our primitive, emotional brain hijacks the system in the heat of the moment. Greed makes us jump in at the very peak, and fear makes us bail out at the absolute bottom. You see, it's not a flaw in the market. It's just a feature of being human. Okay, so let's just say you managed to conquer your emotions. You're a rock. Awesome. Now comes the really hard part, right? Picking the winner. This is the official hunt for the needle. But what are the actual odds? What are the chances of finding a fund manager who can consistently beat the market year after year after year? Let's just look at the evidence, because this isn't theory. This is a massive 30-year study that tracked every single equity fund from 1970 all the way to 1999. It saw everything, booms, busts, the whole shebang. And what it found about our chances of picking a winner, well, it's a real eye-opener. First, just get ready for this jaw-dropping number. Forget even winning for a second. More than half of these funds, 53%, didn't even survive the 30 years. They either went out of business or got swallowed up by other funds. Just think about that. Before you even have a chance to see if you picked a winner, you have a coin flip chance that your fund is just going to disappear. But okay, let's say you got lucky. You picked a survivor. What then? Well, of those funds that actually made it, 7 out of 10 were still losers, meaning they failed to even keep pace with the overall market. So even when you win the survival game, you are still overwhelmingly likely to lose the performance game. So when you put it all together, what were your actual odds of picking a true long-term winner from the very start? A measly 1 in 40. Out of 355 funds, only 9 were true winners. Seriously, your odds of getting struck by lightning are probably better. The search for the needle isn't just hard, it's a statistical impossibility for most of us. Now, at this point, you're probably thinking, okay, fine, I'll just let the experts handle it. And that's a totally fair point. But what if even the experts are playing the same losing game? The data shows they are. And when we dig into why, we uncovered the real villain of this story. And I promise you, it's not what you think. I mean, just take a look at this. Morningstar, they're the gold standard for fund research. These are the funds they picked for their own employees. And even they still underperformed the simple market average by almost 3% a year. So if the experts at Morningstar can't consistently beat the market, what chance do the rest of us really have? So what's the deal here? Are all these managers just bad at their jobs? Not really. The problem isn't the manager, it's the system they're forced to play in. Your investment has to clear 5 massive hurdles before you ever see a dime of profit. You've got sales charges, you've got cash just sitting there doing nothing, you've got hidden trading costs, massive management fees, and of course, taxes. It's this gauntlet of costs, and they're silently eating away at your returns day after day, year after year. So if searching for the needle is a game that's rigged against us by all these costs, what do? Well, we just changed the game. And the solution is so simple, it's almost revolutionary. And here it is. This is the big reveal, the big aha moment. Stop trying to find the needle. Buy the entire haystack. Instead of trying to pick the winners and losers, just own a tiny little piece of every single company. It's really that simple. So how do you actually do that? You do it with an all-market index fund. It's a type of mutual fund with one simple, brilliant job. It buys a tiny slice of every single publicly traded company in the country. It is not trying to be clever. It is not trying to beat the market. It's designed to be the market. You get the full, unadulterated power of the entire economy working for you with absolutely zero guesswork. Now remember those 5 hurdles that were eating away at your returns? Well, watch how an index fund just systematically demolishes them. Are there sales charges to get in? Nope. Is there a big pile of cash sitting on the sidelines? Nope. Trading costs are minimal because they hardly ever trade. There's no star manager to pay, so you get rock-bottom operating fees. And because they don't trade much, it's way more tax-friendly. It's just a fundamentally more efficient way to invest your money. Okay, but you might be thinking, 1% here, 1% there. How much can it really matter in the long run? Well, the answer is a life-changing amount of money. Let's put some real numbers to this and see the staggering cost of chasing that needle. Just look at this. Let's say you invested $10,000 and left it for 15 years. With the average active fund, you'd end up with about $49,000. Not too shabby, but with the index fund, you'd have $90,000. That is almost double the money, and the only difference was choosing the boring, simple, low-cost option. Your future self will thank you for that one. This right here is where it gets really crazy. With a typical active fund, where does the money you earn actually go? Look at this chart. The financial industry and the taxman take more than half of your returns. Just let that sink in for a second. You take all the risk, and they get most of the reward. It's a fundamentally terrible deal. But now, look at the index fund. It is a completely different universe. In this scenario, you, the person who actually invested the money, you get to keep 87% of the returns. You actually get your fair share. This isn't just some small difference. This is the difference between building real, lasting wealth and just spinning your wheels for decades. Okay, the evidence is pretty overwhelming, right? But there's always that one little nagging question that pops up, especially when the market is going haywire. Is now the right time to get in? This is where we shift from the what to do to the how to think. How to think like a successful long-term investor. And so we come full circle, right back to where we started. Forewarned is forearmed. This isn't about trying to predict the future. It's about knowing the rules of the game you're playing, and the evidence is crystal clear. The hunt for the needle is a costly, emotional, and statistically losing game. The winning move is to stop playing. Buy the haystack, keep your costs as low as humanly possible, and just let the power of the entire market work for you over the long run. The real challenge you see isn't timing the market, it's having the discipline to ignore all the noise and just stick with the plan.
Hey everyone, and welcome to The Explainer. This is where we take key source materials and break down the big ideas behind them. Today we're digging into a really powerful speech that was a massive warning sign right at the peak of a historic market bubble.
All right, let's just hop in the time machine for a second. The date is April 6, 2000. The world is just absolutely riding high on the longest and strongest bull market in history. Confidence? It's through the roof. The promise of this new economy feels totally limitless, and pretty much everyone thinks the party is never going to end.
But on this day, at the peak of all that euphoria, one speaker stood up and delivered this powerful, almost poetic warning. In a time that was all about reward, he wanted to talk about the one thing it seemed like everybody had forgotten: risk.
And to really land this point, he didn't just look back a few years. He reached back over 2,000 years to the Roman philosopher Cato. Now, he wasn't trying to predict the future. He was asking a really provocative question. What if this time isn't different? Are we just ignoring all the obvious signs of market madness and walking right into the exact same trap that has caught investors for centuries? Okay, so here's how we're going to break this all down. First, we're going to get the view from 2000 and see what investors could actually control. Then, we'll measure the madness with some hard data. After that, we'll ask if we're seeing déjà vu by looking at history, explore 3 ways to control risk, and finally, we'll figure out what the ultimate risk really is.
So the speaker kicked things off by just stripping investing down to its most basic parts. He basically said that before we can even think about managing risk, we have to be super honest about what we can, and more importantly, what we can't actually control.
And his core message here is so simple, but it's really profound. He argued that future market returns, the reward, are completely unpredictable. Hope, greed, fear, those have always driven markets, and that's not going to change. So we should just stop trying to guess the future and instead focus all our energy on the 3 things we actually have a grip on: the amount of risk we take, our time horizon, and the costs we pay.
All right, let's dive into the data and see the case he built for a massive bubble in the year 2000. He argued that if you look at almost any traditional measure, the market had literally never been more dangerous. For about 70 years, these 3 metrics were like the warning lights on your car's dashboard. Historically, when dividend yields drop below 3%, or the PE ratio, which is just how much you pay for $1 of a company's profit, got above 20, it was a signal that the market was getting too hot. But in 2000, these signals weren't just flashing red, they had completely shattered the dashboard. They were at levels nobody had ever seen before.
And this chart, wow, this chart really gets to the heart of the mania. It shows that there were basically 2 completely different stock markets. You had the established, old economy market, the NYSE, just kind of chugging along. And then you had the tech-heavy NASDAQ, which had gone completely parabolic. In just over 2 decades, it went from being worth a tiny fraction of the NYSE to almost 3/4 of its value. I mean, a staggering divergence fueled by pure tech speculation. And if you pop the hood and look at the engine, the divide is even crazier. The new economy tech stocks were being valued at over 100 times their earnings. That's 4 times the multiple of the old economy. But here's the part that is just truly stunning. Tech stocks made up 64% of the entire market's value, but they were only producing 16% of the actual profits. It's like the market wasn't just discounting the future, it was discounting the hereafter. So just how insane were these expectations? Well, to justify that sky-high valuation back in 2000, the new economy would have needed to grow its earnings by 31% per year, every single year, for a whole decade. I mean, that's a truly Herculean task. The speaker then really hammered the point home with some research from the financial historian Jeremy Siegel. Siegel's analysis showed that, historically, any stock you bought with a PE ratio over 50 ended up underperforming the market. Well, the tech darlings of 2000 had an average PE of 257. His conclusion was blunt. This wasn't an investment, it was a sucker bet. Now, this wasn't the first time markets had been gripped by this kind of mania. You know that old saying, history doesn't repeat, but it often rhymes? Well, the speaker then drew a chillingly precise parallel to a previous boom and bust cycle.
Just look at this comparison. On the left, you've got the go-go funds from the 1960s. On the right, the hot tech funds of the late 90s. The patterns are it's spooky how similar they are. Massive outperformance, a huge flood of investor money, and for the go-go funds, an eventual, absolutely devastating crash. So this historical parallel wasn't just some dusty academic exercise. No, it was posing an urgent, multi-billion-dollar question for every single person piling into tech stocks in the year 2000. If the first story ended in total disaster, how is this one going to end?
So if you're listening to this speech back in 2000, and you're thinking, yikes, okay, the market is super risky, what do I do? Well, the speech then shifted from diagnosis to prescription, laying out 3 totally different ways to think about and control risk.
So he laid out 3 possible paths. 1, stay the course. Basically, just do nothing. 2, the classic textbook answer. Diversify away the risk. And 3, the most direct method of all, reduce exposure.
Now, the speech really focused on the limits of that super popular strategy, diversification.
So why not just diversify? I mean, we've all heard, don't put all your eggs in one basket, right? Well, he pointed out a huge flaw in relying on these fancy models. These charts show something called the efficient frontier. It's the mathematically perfect portfolio based on past data. In 1989, the model said the best thing to do is be 100% in foreign stocks. But just 1 decade later, the exact same model said the complete opposite, be 100% in US stocks. The perfect answer from the past was a terrible guide for the future.
And this all leads to a really damning critique, quoting Professor Bruno Salnick. See, diversification is supposed to work because different things zig when others zag. But during a real crisis, that whole benefit just evaporates. When panic hits, everything falls at once. And that protection you thought you had, it just disappears, right when you need it most.
And that brings us to the final and I think most important part of the speech. It's where he re-examines the very definition of risk itself, arguing that the entire investment industry had gotten it dangerously wrong.
If the whole point of controlling risk is to protect yourself if you're wrong about stocks, he argued the only real protection was bonds. And back in the year 2000, that income gap was just enormous. $1 million in quality bonds could generate $75,000 a year in predictable income. That same million in stocks, just $10,000 in dividends. It wasn't even close.
And this gets to the speech's ultimate definition of risk. It's not the same thing as volatility. Real risk isn't watching your portfolio bounce up and down every day. Real risk is a permanent loss of your money that stops you from funding your essential life goals, like retirement.
And here it is, the big punchline. The speaker, quoting the famous investor Jeremy Grantham, basically argued that the professional investment industry had redefined risk to benefit themselves. Risk management was no longer about protecting a client from permanent loss. It was about managers not straying too far from a benchmark so they wouldn't get fired. It was about controlling their career risk, not their client's capital risk.
So the speech, delivered just weeks before the dot-com bubble started to burst, ended with this timeless provocative challenge. True risk management isn't about building some fancy model to guess the future. It's about accepting that the future is unknowable and building your portfolio to survive the consequences if your best guess turns out to be disastrously wrong. A question that's just as relevant for us today as it was at the peak of the bubble in 2000.
Welcome to The Explainer. Okay, today we are going to dive into what might be one of the worst financial predictions of all time. Seriously. And it's a story that, well, it tells us a whole lot about how the stock market actually works.
So picture this. It's February 1993, and this dramatic headline pops up in a bulletin from the big investment bank Morgan Stanley. They were basically screaming from the rooftops that passive investing was dead. You know, the whole idea of just buying a market index and holding on for dear life. Yeah, they said that was over. A super bold, super confident prediction that everything was about to change.
And you know what? The logic kind of made sense at the time. I mean, for 2 straight years, the average mutual fund, the ones run by those professional stock pickers, had been knocking it out of the park. They were getting 22% a year, while the S&P 500 was only getting 18%. It really looked like the pros had gotten their mojo back and were ready to just own the rest of the 90s. Yeah, well, that forecast could not have been more wrong. I mean, wow. For the rest of the 90s, the S&P 500 didn't just squeak by with a win, it crushed it. By the time 1998 rolled around, the index was up 317%, and the average fund just 219%. That is a huge 100-point difference. So that death rattle they heard? Turns out it wasn't for indexing. It was for their own prediction. So the big question is, how did they get it so spectacularly wrong? To figure that out, we're going to tear down the 5 big myths that keep this idea of active managers being superior alive. We'll start with a really basic one, how we even measure success. And we'll end with, well, a pretty amazing twist to this whole story. Okay, let's jump right into our first myth. This one is all about how we measure success to begin with. Like, are we even using the right yardstick here? I mean, this is the benchmark you hear about constantly, right? On the news, everywhere. It's become the go-to shorthand for the market. But here's the thing. Using it as the one-size-fits-all measuring stick has a really, really big flaw. And the answer is a definite no. Look, the S&P 500 is just 500 of the biggest companies in the US. And yeah, that's about 75% of the total market value, but it totally ignores the other 25%, all those mid-sized and small companies that thousands of funds are specifically designed to invest in. So comparing them is, well, it's like judging a sprinter by marathon rules. It just doesn't make sense. Okay, now this is where things get really interesting. On the left, you've got that S&P 500 comparison we saw. But check out the right. When we switch to the Wilshire 5000, and that one covers the whole US stock market, the whole story just flips. That supposed win for active managers back in 91 and 92, poof, it's gone. And their losing streak for the rest of the decade, well, it still doesn't look great, but it's less of a huge collapse and more of, well, what it actually was, just a slow, steady failure to keep pace with the real market they were supposed to be beating. And that leads us perfectly into our second myth. This really tempting idea that, okay, sure, active managers have done poorly in the past, but the future is going to be different. That was just a fluke, it won't happen again. You've probably heard this phrase a million times. We're entering a stock picker's market. The whole argument is that some special, magical market condition is just around the corner, and that's when the really skilled managers will finally get to show their stuff. But the data tells a very different story. It shows that this underperformance has nothing to do with luck or timing. It's all about simple, cold, hard math. All right, so here's the key takeaway. That 3.4% gap every year, it's not some big mystery. It's really a death by 1,000 cuts. About 1% of it, sure, that was just because large stocks happened to do better back then. But the rest of it, well, 1.3% just disappeared into management fees, the expense ratio. Another 0.7% got eaten up by trading costs because managers were buying and selling so much. And that last 0.7%, that was the penalty for holding cash, which of course does nothing for you in a rising market. These aren't one-off problems. These costs are baked right into the system. And this is exactly why the past is pretty much doomed to repeat itself. These costs aren't some temporary glitch in the matrix. Expense ratios, they're always there. Active funds, by definition, have to trade stocks, and that always costs money. And holding cash, that's always going to hold you back when the market is going up. Since these costs are literally built into the structure of active funds, it's almost a mathematical guarantee that the average fund will underperform over the long haul. Okay, time to tackle myth number 3. And this one is a huge sales pitch you hear all the time. The idea that a clever active manager can see a crash coming and, deftly sidestep it to protect your portfolio when the sky is falling. I mean, it sounds amazing in theory, right? You imagine this brilliant manager seeing the storm clouds on the horizon, coolly selling off stocks, moving into the safety of cash, and just waiting it out. The promise is that they give you this downside protection that a simple index fund, which is always all in, just can't offer. But when you actually look at the data from the 1998 market crash, the exact opposite happened. It's kind of shocking. The average fund was actually riskier and it fell more. We're talking a 22.2% drop, which was worse than both the S&P 500 and the total market index. So that protection they promised? Yeah, it wasn't there. What they delivered instead was more risk and a bigger loss. Ouch. And this next part just perfectly explains why. This chart lines up how much cash mutual funds were holding against what the market was doing. And what you see is that fund managers as a group are historically awful at timing the market. Just terrible. They get the most scared and hold the most cash right at the bottom, like in 74 and 90, literally moments before the market takes off like a rocket. And they're the most confident holding the least cash right before a big crash. They are systematically buying high and selling low, the exact opposite of the one rule everyone knows. All right, that brings us to myth number 4. This is the yeah, but argument. It goes something like, okay, I get it. Indexing works for the big, famous US stocks, but it can't possibly work in those other, less efficient markets, right? Like small companies or international stocks where it's harder to get good information. And on the surface, that argument sounds pretty plausible. It makes sense that in markets where fewer people are looking, a really sharp manager could have a huge advantage finding those hidden gems. And you know what? It's true. The very best managers can outperform by more. But, and this is a huge but, there's a massive flip side. The costs of playing in these sandboxes are way higher. Higher fees, higher trading costs, the whole shebang. So what happens is, while the winners might win by a little more, the losers get absolutely hammered. The penalty for just being average or worse is so much bigger that it completely cancels out any potential advantage. And that brings us to our final section. And folks, this is where the story comes completely full circle, with a twist that is, well, it's just beautifully ironic. So get this. In what has to be one of the most ironic twists in financial history, the very same firm, Morgan Stanley, the one that was so sure they heard the death rattle of indexing back in '93, they put out new research just 5 years later. And that research, it ended up being some of the most powerful evidence in favor of indexing that you could imagine. Just look at this. These are the actual charts from their own report in 1998, and what they found was kind of mind-blowing. A fund's past returns? Almost totally random. If you were a top performer one year, you only had about a 28% chance of doing it again. But risk? Oh, that was a totally different story. A high-risk fund was super likely, like 63% likely, to stay a high-risk fund. The big takeaway here is that performance comes and goes, but a fund's risk level, that stuff is incredibly sticky. It hangs around. Now, this is so important, because if risk is predictable, it means that a fund's risk-adjusted return is also predictable. And that's really the ultimate measure of quality, right? It's the thing that asks, okay, for the amount of risk I took, how much reward did I actually get? Because risk sticks around, the quality of a fund's performance is something you can actually count on. So what happened when they turned this quality meter on the S&P 500 index? Well, you guessed it. It was a top-tier performer, consistently in the top quartile on a risk-adjusted basis. In both of the 5-year periods they looked at, the plain old index delivered elite, high-quality returns. Their own data, their own research, proved that the index wasn't just a good performer, it was a predictably good one. So the conclusion from their own work was just unavoidable. That death knell they thought they heard back in '93, it wasn't for indexing. Not at all. It was for the active managers who just couldn't keep up. Not because they were unlucky, but because of that relentless, unavoidable drag from their own costs. Their big prediction was turned completely upside down by their own research. And that leaves us with one last, really important question to think about. If the math is this simple and the evidence is this overwhelming, why on earth does this myth of the superstar active manager still have such a powerful hold on us?
Today, we're going to unpack a landmark speech from 1999 that completely flipped the script on how we think about investing. It's really the story of an idea that went from being called a Wall Street heresy to becoming, well, the undeniable truth. And it all kicked off with one single revolutionary fund.
Yeah, you heard that right. Un-American. That is seriously how the world's first index fund was described when it launched back in 1975. I mean, it was attacked, it was mocked. People saw it as some kind of assault on the very soul of American capitalism. You know, the idea of picking the winning stocks. But, as we're about to see, this un-American idea had some seriously powerful and pretty undeniable math on its side.
And just look at this. From a tiny, almost laughable start of $11 million, that one fund exploded to over $100 billion by the time this speech was given. That's a compound growth rate of almost 50% a year. This right here, this is the exact moment a wild-eyed heresy officially became accepted dogma. The game had changed.
All right, so here's our game plan. First, we'll cover that journey from heresy to dogma. Then we'll dig into the simple genius of owning the haystack. After that, we'll see how a great idea got twisted into a tool for pure speculation. Then we'll tackle the big one, the active manager illusion. And finally, we'll find out who really wins in this whole game.
So, you have to ask, right? How did this idea go from being laughed out of the room to becoming the foundation of the modern industry? Well, it all comes down to a really simple and honestly kind of brutal mathematical truth about how the market actually works.
Okay, here it is. This is the whole argument in a nutshell. Think about it. If you take all the active investors, all the pros, the stock pickers, the market timers, and you put them all together in one giant group, what do you have? You have the market itself. They are the market. But, and this is the crucial part, before they get to take home the market's return, they all have to pay to play. Fees, commissions, taxes, all those costs get taken out first. And that means as a group, they are mathematically guaranteed to underperform the market. It's not a theory, it's just arithmetic.
So, if trying to beat the market is a guaranteed losing game for the group as a whole, what's the alternative? Well, let's look at how this basic idea leads to a strategy that's not just powerful, but beautiful in its simplicity.
You're really looking at two totally different philosophies here.
On one side, you've got indexing. That's about buying a small piece of every public business in the country and just holding on, basically forever. You're thinking like an owner. Then you have the other world, active management. At the time, they were just trading pieces of paper, flipping stocks with an average hold time of just over a year. That's not an ownership mindset. That's a trading mindset.
And this one question really captures the entire idea perfectly. That needle is the one magic stock, or the one genius fund manager that you're desperately trying to find. That search is expensive, it's exhausting, and it's mostly luck. So the index fund strategy just says, you know what, forget the needle, just buy the whole haystack. It's that simple.
And the price for ignoring this simple idea? It can be huge. See, when a rival bank made a high-cost copycat of that first index fund, they literally called it their cash cow. And for good reason. If you put $10,000 in that cash cow for 15 years, you would have ended up with $27,000 less than someone who just bought the cheap original version. That's the real-world cost of high fees, right there.
Okay, but you know what happens when a good idea gets popular, right? People start to mess with it. New products came along that looked like index funds on the outside, but they were designed for a purpose that was the polar opposite of the original long-term vision.
And here's the main culprit, the exchange-traded fund, or ETF. Back in 1999, these things were the hottest new item on Wall Street. Now they track an index, just like a regular index fund, but you can trade them all day long, every second, just like a stock. And that one feature, as brilliant as it was, turned a tool for long-term investing into the perfect machine for short-term speculation.
And the results were just wild. I mean, look at this. The original index fund had investors turning over shares at about 10% a year. People were buying and holding. But the ETFs, the S&P 500 ETF, had a turnover of 1,800%. The average person held it for just 20 days. And the super speculative NASDAQ ETF, a mind-blowing 7,800% turnover. That means the average share was held for just 4 days. This isn't investing anymore. It's just pure gambling.
And if you needed any more proof, this quote from a big ETF sponsor at the time says it all. Like toothpaste. Just let that sink in for a second. It really shows this giant split in philosophy. Are you creating an investment designed to serve a long-term owner, or are you just designing a product to sell to a short-term trader?
But hey, what about those times when the pros do seem to be winning? I mean, in 1999, the year of this speech, the headlines were all celebrating the fact that active managers were beating the indexes. So this brings us right to the absolute heart of the matter.
It's such a simple question, but the answer really gets to the core of how all this works. If one group of managers is doing better than the market, where does that extra money come from? It's not magic. Who's on the other side of those winning trades?
And there it is, the simple, kind of shocking answer. The losers are the other active managers. See, before you even factor in costs, it's a zero-sum game. For every active manager who makes a brilliant trade and wins, another active manager has to be on the losing side of that same trade. It's just a transfer of money from one pocket to another. And the whole time, the passive index investor is just sitting on the sidelines, collecting the market's return with almost no cost.
So if the math is that clear, why does it sometimes look like they're winning? Well, it's because the data you see is usually twisted by these 5 illusions. First, they compare themselves to the wrong index. Second, their selection bias, where they only launch the funds that had a lucky streak in private testing. Third, and this one's a big one, is survivor bias. All the funds that fail and shut down, they just get erased from history, which makes the average of the ones left look way better. And of course, they almost never include the sales charges or the massive tax bills their constant trading creates.
So what happens when you account for all that stuff? When you do a real apples-to-apples comparison for a regular person paying taxes, the picture becomes crystal clear. Over the 15 years before this speech, the average active fund investor made 384%. The all-market index fund investor, a jaw-dropping 804%. I mean, that's more than double the return. The difference is just absolutely breathtaking. All right, so let's zoom out as we wrap things up here. Let's get away from the specific numbers and focus on the timeless, simple wisdom behind this whole strategy. Because this isn't some new idea, it's a principle that's been around for centuries.
This is Occam's razor, a basic principle from way back in the 14th century. We're taught that investing is incredibly complex, with a million different strategies and products. But the theory of indexing just applies this ancient wisdom. It says the simplest solution, just owning the whole market for next to nothing, is also the most powerful one.
And you just can't argue with the logic. Way back in 1908, an economist showed that in a fair game, a speculator's mathematical expectation of winning is 0. It's a coin flip. But investing isn't a fair game. There are costs involved. So you start at 0, and then you subtract all the fees and commissions. That leaves you with a negative expectation. The only people who are guaranteed to win are the people who collect all those costs.
And that brings us to the ultimate point. If you think about the stock market like a giant casino, it's not the players who get rich over the long haul. It's the house. The financial industry, the croupiers, are the ones who always win because they're collecting fees from all the complexity and all the frantic betting.
So, I'll just leave you with this final, powerful question to think about. It comes from an old Wall Street story, where a visitor is being shown all the magnificent private jets owned by the brokers and the bankers. And after looking around for a while, the visitor just asks this one simple question. It pretty much says it all, doesn't it? Something to think about. Today, we are going to crack open a bit of a time capsule. We're diving into a classic investment article from way back in 1992 that tackles this really fascinating paradox. Why is it so ridiculously hard to pick the single winning investment fund, but actually incredibly easy to pick a winning fund? It sounds weird, I know. So let's get right into it.
I mean, this is the million-dollar question, isn't it? If you're trying to invest, you're faced with this. Do you go with the fund that was a total superstar last year, the one all the magazines are hyping up? Or is there a smarter, maybe less obvious way to play the game? Well, that's the exact problem that this classic article sets out to solve.
And the author doesn't waste any time. The opening line just hits you. It says, investment management is a field fraught with fragility and fallibility, a field in which today's careful, rational fund selections are too often tomorrow's embarrassments. Wow! I mean, this was published in the Journal of Portfolio Management, so this isn't just some casual opinion. It's a serious analysis that basically argues our most common instincts about investing, they might be leading us completely astray. So, here's how we're going to break it down, following the article's logic. First, we'll look at that common hunt for the one perfect fund. Then, we're going to see what happens when you test that idea against a decade of real data. After that, we'll uncover the simple but really powerful logic of picking a winner instead. We'll also expose the one hidden hurdle that trips up most investors. And finally, we'll see what all this wisdom from 1992 really means for us right now.
All right, let's start with the strategy that just about everyone thinks of first. You look at a list of funds, find the ones that did the best last year, and you put your money there. It just seems so logical, right? Of course you'd bet on a proven winner. But as we're about to find out, this whole strategy is built on a very sneaky statistical trap.
And that trap has a name: regression to the mean. It's a core concept in statistics, and it's pretty simple when you think about it. Basically, things that are way out on the extreme ends, super high or super low, tend to move back toward the middle over time. You know, like a basketball player who has an unbelievable record-breaking season. The next year, they're probably still going to be great, but odds are they'll be a little closer to their normal average. Well, it turns out the exact same thing happens with investment funds. So the author of this paper didn't just talk about this idea. They put it to the test. They actually ran the numbers. They dug into a full decade of fund performance from the 1980s to see if last year's champions could really keep their crowns. And what they found? Well, it's pretty brutal. The study looked at the top 20 best-performing funds for each year throughout the 1980s. In their big winning year, these funds had a mind-blowing average return of over 45%. You'd think you'd struck gold, but what happened the very next year? On average, their rank just plummeted, all the way down to 249th out of 554 funds. They went from the absolute best of the best to way below average. It's a perfect, painful example of regression to the mean in action. So picture this. You find it. The one. It's ranked number 1. It's the hero of your portfolio, the fund that just can't seem to lose. You put your money in, expecting that incredible performance to continue, and then this happens. On average, your number 1 champion becomes profoundly, disappointingly average. It's like trying to drive your car forward by looking only in the rearview mirror. What was hot yesterday tells you almost nothing about what's going to happen tomorrow. And believe me, this isn't just a one-year fluke. The author then took a bigger view, looking at entire decades. So of the top 20 funds from the 1970s, guess how many stayed in the top 20 for the 1980s? Just 2. And get this, the 4th best fund of the entire 1970s became the absolute dead last worst performing fund in the 1980s.
The takeaway here is just crystal clear. Past performance isn't just a poor predictor of the future, it's pretty much useless.
Okay, so picking funds based on last year's numbers is a bad idea. We get it. But what about a more sophisticated strategy? So the article then tests a very famous list from back in the day, the Forbes Honor Roll. This wasn't just a list of top performers. It was carefully selected based on long-term results, how funds did in both good and bad markets, all the smart stuff. This was supposed to be the smart money approach.
So, how did this expert-picked list actually do? Well, between 1974 and 1990, these elite honor roll funds returned about 12.2% per year. And the average run-of-the-mill equity fund, it returned 11.8%. So yeah, the experts did a tiny bit better, but it's practically a rounding error. For all that careful, smart selection, it barely moved the needle. But hang on, the story does not end there.
And this is where it all clicks into place. You see, those previous numbers were missing one huge real-world factor: costs. Once you factor in all the fees and sales commissions for those honor roll funds, their actual take-home return drops to 10.4%. Now compare that to just owning the entire stock market, which is represented here by the Wilshire 5000 Index. That returned 12.4% a year. All of a sudden, the smart strategy is losing by a full 2 percentage points every single year.
So what does a 2% difference every year actually look like in real dollars? Well, if you had invested $10,000 back in 1974, that carefully selected honor roll strategy would have turned it into about $53,800. Not bad. But if you had just bought the entire market and just left it alone, you'd have over $70,000. That nearly $17,000 difference, that's the price you paid for trying to be clever and pick the winners.
So, if trying to pick the winner is clearly a losing game, how in the world do we guarantee that we pick a winner? The article now switches gears. It moves away from past data and instead lays out a simple, incredibly powerful, and mathematically unavoidable proof that answers that very question.
And the logic is just beautiful in its simplicity. Here it is. Step 1. Before you subtract any fees, all investors combined, the active stock pickers and the passive folks who just buy the index, they are the market. So their total return has to equal the market's return. Make sense? Step 2. We know for a fact that passive index funds have way lower fees than actively managed funds. That's just how they're built. So step 3, if both groups start at the exact same place, the market return, but the active group pays way more in cost to play the game, then the passive group must, by simple arithmetic, end up with a higher average return after all those costs are paid.
And as the mathematicians like to say, QED. It's proven. It's not a theory, it's not a matter of opinion, it's just a mathematical certainty. The surest way to be a winner isn't to try and find that one magical needle in the haystack, but to simply buy the entire haystack at the lowest possible cost.
So if the math is so simple and so clear, why doesn't everyone just do this? Well, the article points to a few very human reasons. First, it just feels weird, right? The idea that doing nothing, just buying an index fund, is better than hiring a team of brilliant, highly paid experts just doesn't feel right. Second, let's be honest, the financial industry makes a lot more money selling you complicated, high-fee products. And third, it's just our nature. Hope springs eternal. We all want to believe that we can be the one to beat the odds.
Let's really drill down on that critical factor, costs. The author argues that when you look at the long run, costs are actually the most reliable predictor of what your final returns will be. They are the single biggest hurdle standing between you and your financial goals.
And let's look at just how damaging those costs can be. Let's say the market has a pretty good year and returns 10%. Now, if your fund has total costs of 2.5%, you haven't just lost 2.5% of your money. No, you've given up a full quarter of your potential gains for that year. 25% of your return is just gone, eaten up by fees before you ever see it.
And what's really amazing is that the author was making this point back in 1992. See, during the crazy bull market of the 1980s, returns were a massive 17.5% a year. So a 2.5% fee was noticeable, but it didn't feel catastrophic. But the author predicted that if returns fell back to a more normal historical average of around 10%, that same 2.5% cost would suddenly eat up a much bigger slice of the pie. And the lesson is critical. The lower the market's overall return, the more devastating those fixed costs become.
And that brings us to our final section. What does all this wisdom, written decades ago, really mean for us today?
While the incredible thing is just how little the core truth has changed. The math is still the same, our human psychology is still the same, and these lessons are probably more relevant now than they've ever been.
So let's boil it all down to the essentials. First takeaway, stop chasing last year's hot funds. The data is overwhelming, it's a loser's game, period. Second, the easiest way to guarantee you own a winning investment is to just own all of them through a low-cost total market index fund. You'll never be the #1 performer, but you're guaranteed to never be a loser relative to the market. And finally, and this is probably the most important part, focus on what you can actually control. You can't control the stock market, but you can control your costs. Minimizing them is the single most powerful move you can make for your future.
And that leaves us with one last question to think about. The logic we've just walked through isn't new. It was laid out with perfect clarity back in 1992. And yet, if you turn on the TV or browse the internet today, it's still filled with lists of hot funds to buy now, and investors are still pouring money into last year's big winners. So the question is, why? If the math is so simple, why is this behavior still so common? What does that tell you about the gap between knowing the right thing to do and actually doing it?
You know, whenever we talk about mutual funds, our minds almost always jump straight to stocks. But if that's all we're looking at, we are missing a massive piece of the puzzle. There's this other huge investment world out there, one that's a lot quieter, but as you're about to see, incredibly powerful. So today, we're pulling back the curtain on the world of bond funds.
I mean, just think about it. Our news feeds, the headlines, they're all jam-packed with stories about superstar stock pickers and these high-flying equity funds, right? Well, that creates a massive blind spot, and it causes most investors to totally overlook a huge, and I mean huge, and fundamentally different part of the market.
Exactly. The best way to think of it is like this. If equity funds were the first great mutual fund industry, and money market funds were the second, then bond funds are the third. They are this quiet giant that's been changing the investment landscape for decades, usually without making any of the big headlines.
So, to put some numbers on this, the analysis we're digging into today is from 1992, but honestly, the principles are timeless. So back then, bond fund assets were a staggering $440 billion. And that's not just a big number. Get this, it was actually more than the $430 billion in stock funds at the time. This wasn't some niche product, it was a dominant force.
And we're not talking about some flash in the pan either. Just look at this chart. For the 25 years leading up to 1992, bond fund assets grew at 22% per year. That's more than double the growth of equity funds. It was this quiet explosion happening right under the market's nose.
Okay, so here's our game plan for this explainer. We're going to give this giant its due. We'll explore why it's called the third industry and, more importantly, why you should care. Then we'll get into the practical stuff. 5 rules for picking the right fund and 5 crucial warnings to help you avoid the common traps. And then finally, we'll wrap it all up with a simple, sensible strategy.
So, first things first, let's really get our heads around just how vast this bond fund universe really is. You know, we tend to think of bonds as these simple IOUs from a government or a company, but the reality? Oh, it's a sprawling ecosystem with a shocking amount of variety.
Think about stock funds for a second. We can usually sort them into, maybe 9 different boxes? Large cap, small cap, growth, value, that kind of thing. Okay, now look at bond funds. We are talking about at least 21 distinct categories. You've got different maturities, short, intermediate, long-term, and those are spread across totally different sectors, from U.S. government bonds all the way to high-yield junk bonds. The diversity is just immense.
So, with all this complexity, you might be asking why even bother, right? If stocks get all the glory, what's the real reason to own bond funds? Well, it turns out they can be the absolute bedrock of a solid portfolio.
Okay, so the first hurdle for a lot of people is this historical data. If you look all the way back to 1926, stocks returned over 10% a year on average. Corporate bonds, just over 5%. Looking at that, you'd probably think, well, why would I ever choose bonds? It kind of seems like an open and shut case.
But, and this is a huge but, here's a powerful counterargument. The author calls this historical evidence, because it's fixated on the past. Back in 1992, when this was written, the starting interest rate on bonds was nearly 9%, almost double the historical average. And here's the key insight. A bond's starting yield is the single best predictor of its future return. The past just didn't matter as much as the present.
But look, it's not just about returns. Bonds are also your portfolio's defense. They are the cushion that can soften the blow when stocks take a nosedive. And at the same time, they offer way better income than just letting your money sit in cash. Just look at this yield curve from '92. A 3-year Treasury offered almost 6%. That's a huge step up from a short-term bill. That extra yield gives you both income and a buffer against all that market volatility.
Okay, so let's say you're convinced bond funds have a place in your portfolio. Great, but with 21 different types to pick from, how in the world do you make a smart decision? Well, that brings us to our 5 golden rules for selection.
All right, rule number 1. This one gets right to the very heart of bond investing. It's not about trying to avoid risk altogether, it's about choosing your risk. Every single bond investor faces this fundamental trade-off between 2 opposing dangers: the risk of losing your initial investment or the risk of losing your future income.
Let's break this down. Principal risk is what most of us think of when we hear risk. It's the chance that your bond's price will drop. This happens when interest rates go up, and it hits long-term bonds the hardest. But on the other side of the seesaw is income risk. That's the danger that when your short-term bond matures, you'll have to reinvest your cash at much lower interest rates. So, a 30-year bond, high principal risk but low income risk. A 3-month bill is the exact opposite. Your job as an investor is to figure out where on that scale you're comfortable.
And that leads us perfectly into rule number 2. Your time horizon is everything. Now here's the part that might mess with your head a little. For a short-term investor, rising interest rates are bad news, period. They hurt your bond's value. But for a long-term investor, believe it or not, rising rates can actually be a huge blessing. Here's why. This number shows the mind-blowing power of compounding. Imagine you invest $10,000 for 25 years. If rates immediately jump, yeah, you're going to feel some short-term pain as your bond's price dips. But because you get to reinvest all your interest payments at those new, higher rates, your investment balloons to almost $94,000. If rates had fallen instead, you'd have only ended up with $55,000. The lesson is crystal clear. A little short-term pain from higher rates can lead to massive long-term gain.
The last 3 rules round out our toolkit. Rule 3 is all about quality. You have to know who you're lending your money to. There is a world of difference between a U.S. Treasury bond and a junk bond. Rule 4 is to keep an eye out for special risks, like currency risk if you're looking at foreign bonds. And Rule 5 is simple but absolutely crucial. Always consider taxes. A lower-yielding municipal bond might actually put more money in your pocket than a taxable one.
All right, so now that we've got the rules for what to do, let's flip the script and talk about what not to do. Here are 5 critical warnings about the traps that can so easily snare bond fund investors.
Warning number 1 is, without a doubt, the most important of all. Always know the expense ratio. In the bond world, where one government bond is pretty much like any other, high costs are a guaranteed way to underperform. And the range in these costs is just staggering. As this table shows, you can have funds in the very same category where the fees are miles apart.
In this chart, it shows you exactly what those costs do to your money. They come directly out of your yield. If the bonds in a fund's portfolio yield 8%, a 1% fee means you only get 7%. A 2% fee means you only get 6%. It is a direct transfer of wealth from your pocket to the fund company's pocket. It's that simple. Higher costs guarantee lower returns.
Let's just see how this plays out in the real world. Here we have 2 municipal bond funds. Fund A is packed with high-quality bonds and has a teeny-tiny 0.3% expense ratio. The result? The investor gets 7.1%. Now look at Fund Z. It's much lower quality, but it charges a massive 2% fee, and the result is a lower yield of 5.8%. Now just think about that for a second. The investor in Fund Z is taking on more risk for a lower return. It makes absolutely no sense.
And this quote just nails it. It perfectly captures the absurdity of that trade-off. When a fund's high expenses completely gobble up the extra yield you're supposed to get for taking on more risk, you are getting a raw deal. You're paying a premium price for a lower quality product.
The other warnings are just as critical. First up, watch out for sales charges, what they call loads. They can absolutely destroy your first year's return. Second, do not trust the advertised yield. Always ask for the yield to maturity to get the real, complete picture. And finally, steer clear of the gimmick funds. If a strategy seems way too complex or just sounds too good to be true, it probably is.
So, after all these rules and all these warnings, what's the single most important takeaway? What does a truly sensible bond fund strategy actually look like? Let's put it all together.
You know, it really all boils down to this.
In the bond market, there are only two ways to get a higher return. You can either take on more risk through longer maturities or lower quality bonds, or you can cut your costs. And of those two paths, cutting your costs is the only free lunch in the entire game. It is the single most sensible and productive thing you can do as an investor. It's the one factor you can completely control, and it adds directly to your bottom line.
And that really leaves us with one final crucial question you have to ask yourself. When you look at a fund with sky-high expenses and so-so quality, you just have to wonder, who is really benefiting from this arrangement? Is that fund's strategy designed to maximize your return, or is it really designed to maximize the manager's fee income? Thinking about that just might be the most important investment decision you ever make.
All right, let's dive into the world of mutual funds. I mean, it's an absolute giant, right? For millions of families, it's the way to invest. But here's the thing about giants. They cast some seriously long shadows. So in this explainer, we're going to look at both sides of the coin. The brilliant light that powered its incredible success and, well, the surprising darkness that came right along with it.
You know, this ancient quote really nails the theme for today. It's a perfect reminder that to truly get what's going on, you've got to look past that dazzling, shiny surface. And believe me, when it comes to the mutual fund industry, there is so much more happening than what first meets the eye.
So how in the world did mutual funds get to be so dominant? I mean, for generations, most families just stuck to the basics. Simple savings accounts, maybe some life insurance, a pension if you were lucky. But then, mutual funds came roaring onto the scene and just completely changed the game. They basically became the default way we all save and invest for the future.
The famous economist, Joseph Schumpeter, had a name for this: creative destruction. It's this idea that a new industry can be so innovative, so revolutionary, that it doesn't just compete with the old way of doing things, it makes it obsolete. And the rise of mutual funds? It's a textbook example of this in action. A total revolution in personal finance.
So you might be asking, what exactly fueled this revolution? Well, it wasn't just one thing. The industry's incredible success was really lit up by what you could call four shining stars. Four powerful forces that all converged at the exact perfect moment to create the financial behemoth we know today.
And here they are, the four pillars of that incredible growth. First, and this one is the big one, was a historic bull market, the likes of which nobody had ever seen before. Then you had some really helpful changes to the tax code. On top of that, a technology revolution that suddenly made investing easy for pretty much everyone. And finally, a huge burst of creative innovation from the industry itself.
Let's start with that bull market, because its power was just staggering. Seriously, for 15 years, from 1982 all the way into the late 90s, the market went on the longest, strongest, most incredible run in American history. The Dow Jones didn't just climb, it exploded. We're talking a 10-fold increase. That works out to an annual return of 19% a year. Just an absolutely massive wave for the industry to catch and ride.
And oh boy, did they ride it. Over that exact same 15-year period, the assets in mutual funds grew 17 times over. That's not a typo. From $260 billion to a mind-boggling $4.3 trillion. In fact, equity funds were doubling in size every 2.5 years. This is how you go from being a relatively small part of the financial world to an absolute giant.
Now, what's really fascinating is what all that growth meant for their power and influence. Just think about this shift. 15 years earlier, funds owned a tiny 3% of all stocks. But by 1998, they owned 22%. And if you tack on the other accounts they were managing, it was a full third of the entire stock market. This kind of massive ownership gave fund managers an unbelievable amount of power over corporate America.
So the bull market was definitely the main engine, but these other three stars were the high-octane fuel. You had the government creating these amazing tax-deferred accounts like IRAs and 401ks, which just sparked this huge new demand. Then technology, with simple 800 numbers and computers, made investing super easy for everybody. And of course, the industry itself was innovating like crazy, creating thousands of new funds. You know, a fund for every purpose under heaven, as the saying goes.
Okay, so it all sounds pretty amazing, right? A perfect success story. But here's where our story takes a really sharp turn. You know the old saying, all that glitters is not gold? Well, it turns out that every single one of those four shining stars, the market, the tax breaks, the tech, the innovation, each one cast a long, dark shadow of its own. And that's what we have to look at now.
And this brings us to what is probably the single most important question of this whole explainer. With this once-in-a-lifetime market boom and this insane industry growth, did the average person who was putting their hard-earned money into these funds actually get their fair share of the rewards? The answer, frankly, is pretty shocking.
And this really lays out the core problem perfectly. Let's say you put $10,000 into a simple, boring index fund that just tracked the market back in 1982. By 1998, it would have grown to $112,000. Pretty great. But that same 10 grand in the average actively managed equity fund, it only grew to $72,000. That's a $40,000 gap. The typical investor was left with less than 2/3 of what the market actually gave them.
So why? What happened to that 40 grand? Was it just bad luck or bad stock picking? No. The real culprit was the heavy, relentless weight of costs. The average fund was running the race with a 2% per year cost handicap from all its fees and expenses. Now, 2% might not sound like a lot, but over 15 years, that compounding drag becomes an absolutely enormous anchor on performance. A very, very expensive failure for shareholders. So that massive underperformance due to costs, that was the dark side of that brilliant bull market star. But it doesn't stop there. The other stars, taxes, tech, and innovation, they had their own dark sides too, creating a whole mess of unintended consequences that ended up hurting investors in the long run.
Let's talk about taxes. See, fund managers are always trying to beat the market, which means they're trading stocks constantly. The average equity fund today has a portfolio turnover rate of 90%. Let that sink in. It means only 10% of the stocks a fund owns at the beginning of the year are still there at the end. The problem is, all this frantic trading, this kind of casino capitalism, doesn't actually make the returns any better for the industry as a whole. They're all just trading stocks back and forth with each other.
But you know what all that turnover does do? It creates a huge tax bill. See, every time a fund sells a stock for a profit, it generates a capital gain that gets passed directly on to you, the shareholder. And this constant churning can take that performance lag from around 3% before taxes to over 4% after taxes. It's this massive hidden cost that the investor, and only the investor, ends up paying.
And then there's technology. Oh, the law of unintended consequences is on full display here. All that amazing tech that gave us instant information and lightning-fast trades, it's had a really serious downside. Back in the early 80s, people held on to their mutual funds for over 10 years. Today, it's less than 3. We've somehow managed to turn what should be the world's best vehicle for long-term investing into a tool for short-term gambling.
And this brings us right to the dark side of innovation. Somewhere along the line, the industry's creative energy shifted away from creating real value for investors and focused on just one thing: marketing. It's become less about being a fiduciary, a trustee for your money, and more about selling a consumer product. As one senior marketer in the industry actually said, "We're selling hope, like perfume, appealing to that fantasy of getting rich quick." Now, this next part is a true paradox. I mean, in almost any other industry, when you grow and get bigger, you get more efficient. You get economies of scale and your costs go down, right? Well, not here. While equity fund assets grew by an incredible 65 times, the average expense ratio actually went up by over 50%. So who benefited from all that massive growth? It wasn't the fund shareholders. It was the fund managers who got to collect higher and higher fees on a much bigger pile of money.
So after hearing all this, after seeing the dark side of every one of those shining stars, you might be wondering, where do we possibly go from here? And yeah, the issues are pretty troubling, but there is a path forward. There is a way for investors to step out of these shadows and back into the light.
This whole situation reminds me of Plato's famous allegory of the cave. He described these prisoners who've spent their whole lives chained up, only able to see shadows dancing on the wall in front of them, and they mistake those shadows for reality. So many investors are in a similar spot. They only see the marketing sizzle and the past performance numbers, the shadows, and not the true reality of costs, taxes, and structure, which are the fire casting those shadows in the first place.
So how do you get out of the cave? Well, seeing the light means taking some action. First, you've got to get informed. Really understand just how much things like costs and taxes eat away at your returns, and demand better information. Second, focus on actual value, not flashy marketing. Here's a secret. The simplest, shortest route to top-tier performance is choosing funds with bottom-tier expenses and, finally, vote with your feet. Choose low-cost funds, commit to a real long-term strategy, and just ignore all the short-term noise.
But of course, individual actions can only go so far. The ultimate solution here might have to be structural. The source material we're looking at proposes a really simple but pretty radical idea. What if the funds were actually owned and controlled by us, the shareholders? Imagine a mutualized structure where the entire organization has only one job, one single focus, serving the interests of its owners, not some separate management company.
And that leaves us right here with this final provocative question. This really gets to the very heart of the conflict we've talked about today. Who is this giant industry ultimately built to serve? Should its main purpose be to generate huge profits for the management companies that run the funds? Or should it be to generate the best possible returns for the millions of people like us who actually own them? The answer to that question is going to define the future of investing for all of us.
Okay, I want you to picture this. It's 1999. The stock market is absolutely on fire, and it feels like everybody is getting rich. Then, the founder of Vanguard, John Bogle, he steps onto a stage and gives a speech that just peels back the curtain on the entire mutual fund industry. He called it Economics 101. And wow, was it a masterclass in how the whole system actually works. So today, we are going to unpack that powerful and still, pretty controversial analysis. All right, so here's how we're going to break this all down. First, we'll look at the industry's insane growth, what Bogle called the stampede. Then, we're going to dig into the 4 hidden flaws that he saw lurking just beneath the surface. After that, we'll follow the money to see who's really getting rich here. We'll dissect the industry's fuzzy math. And finally, we'll look at what Bogle saw as your best defense as an investor. So, first things first. To really get why Bogle was so fired up, you have to appreciate the sheer, unbelievable scale of what he was talking about. This wasn't just a little bit of growth, it was a total financial phenomenon, a true stampede. I mean, just think about this. In 1974, after a really nasty market crash, the entire mutual fund industry was practically on life support. Assets were down to just $36 billion. But then, an innovation came along that changed everything: the money market fund. It took advantage of sky-high interest rates, and by 1982, it had fueled this massive comeback, paving the way for the historic bull market that would create a nearly $6 trillion empire. Bogle used this brilliant metaphor for this whole transformation. He called the industry a leopard. So check this out. In 1977, that inner ring, the leopard spots, were almost all stock funds. Makes sense. But just 5 years later, look at that outer ring. The leopard had completely changed its spots. By 1982, money market funds made up a whopping 76% of the entire industry. It was a totally different animal. And this number right here, it shows you exactly what that all led to. By 1998, mutual funds weren't just one of the options for savers. They were basically the only option. They captured nearly every single new dollar of American family savings. Yeah, Bogle was spot on to call it a stampede. But here's the thing Bogle was trying to tell everyone. Beneath this incredible, shiny success story, there were some really serious cracks in the foundation. Now, these flaws were super easy to ignore when the market was roaring, but trust me, they were there, and they were a huge deal. So Bogle laid out these 4 big problems. First, you've got the performance flaw. Simply put, funds just weren't keeping up with the market. Second, the cost flaw, and this wasn't an accident. It was a direct result of crazy high fees. Third, the future flaw. Basically, the party couldn't last forever. And finally, the success flaw, this weird paradox where the industry's own massive size made it impossible to outperform. All right, first, let's hit performance. And the numbers here, they're pretty shocking. During that monster bull market, the stock market itself was delivering a ridiculous 18.6% a year. Investors were ecstatic, right? But the average stock fund they were actually invested in, it only earned 15.8%. That's a gap of almost 3 percentage points every single year. And this is where that little gap turns into a Grand Canyon over time. Bogle had a great name for it, the tyranny of compounding. Just look at the numbers. If you'd put $10,000 in the market, it would have grown to $167,000. Not bad. But in the average fund, that same $10,000 only grew to $113,000. That is a massive, massive difference. It really shows you how costs just relentlessly chew away at your wealth. So you've got to be asking, where did all that missing money go? Was it just bad luck? Nope. Bogle's answer was brutally simple: costs. That performance lag wasn't random. It was basically by design. It almost perfectly matched the all-in cost of investing. You know, the expense ratios they have to tell you about, plus all the hidden trading costs. The managers were pretty much just taking it right off the top.
And that brings us to that fourth flaw, the paradox of success. As the industry got bigger and bigger, its ability to actually beat the market got smaller and smaller. And Warren Buffett, quoted right here, has said the same thing for years. Having a fat wallet makes it incredibly hard to be quick and find an edge.
By 1999, you have to understand, mutual funds were the market. They controlled a third of all stocks and did 2/3 of all the trading. So what does that mean? It means they were mostly just trading stocks back and forth with each other. Before costs, that's what you call a zero-sum game. For every winner, there has to be a loser. But, as Bogle brilliantly put it, it becomes a loser's game after the croupiers, the fund managers, take their generous cut of all the bets.
All right, to really get a handle on just how big these costs were, Bogle said you have to do one simple thing. Just like they said during Watergate, you have to follow the money. So let's see exactly where all those fees were actually going. In the year he gave this speech, Bogle estimated that investors would pay, get ready for this, $50 billion in expenses to fund managers. $50 billion. So the question is, where did all of it go? So here's Bogle's breakdown, and honestly, it's jaw-dropping. Only 10%, just a tiny slice of what investors paid, actually went to managing the portfolio. You know, the actual work of picking stocks and doing research. A huge chunk, almost a third, went to shareholder services. Another 16% went to marketing to suck in more investors. And the biggest piece of the pie, a full 40%, or $20 billion, was just pure pre-tax profit for the management companies. And that led Bogle to ask this really sharp, pointed question. Think about it. Investors put up 100% of the money and take 100% of the risk. But the managers, who take zero risk, they walk away with a massive chunk of the return. Is that really a fair system? Does it represent capitalism's finest hour? So obviously, the industry wasn't just going to sit there and take this, right? Of course not. They fought back with their own arguments and their own data. But Bogle's takedown of their defense revealed what he called fuzzy math. So here was the industry's official line, straight from their main trade group. Their argument was pretty simple. Hey, we compete really hard on price, and that keeps costs fair for all of you investors. But Bogle, being Bogle, he came with the receipts. He pointed to the actual facts, which told a totally different story. First, the so-called lowest-cost funds had actually raised their fees by 27%. Second, a single low-cost provider, yep, his own company, Vanguard, was grabbing a massive 90% of all new investment money. And third, despite all that success, nobody, not one competitor, was trying to copy their low-cost strategy. That, he argued, is the exact opposite of vigorous price competition. And what this all boils down to is a fundamental built-in conflict of interest right at the heart of the industry. You have entrepreneurship, the drive to make profits for the management company on one side, and on the other, you have fiduciary duty, the legal obligation to do what's best for investors. Those two goals are pulling in completely opposite directions. Okay, so if the system's got all these built-in problems, what are you, the investors, supposed to do about it? Well, Bogle didn't just point out the flaws. He ended his speech by offering a really clear path forward, a way for investors to protect themselves. This was what Bogle called the future flaw. He warned everyone that those insane 18% returns of the past, they were not normal. They were an anomaly. And in a world with more normal, lower returns, costs suddenly matter exponentially more. Think about it like this. A 2.5% fee on an 18% return eats up about 14% of your profits. Annoying, but okay. But what happens when the market only returns 7.5%? That same 2.5% fee now devours a devastating 1/3 of your entire profit. And the simplest way to get costs as low as possible, Bogle argued, is to stop playing the game of trying to beat the market and to just buy the market through a low-cost index fund. And listen, this wasn't just him talking his own book. Even Peter Lynch, who is arguably the greatest active fund manager of all time, even he admitted that for most regular investors, indexing is simply the better way to go. In the end, the entire message from that incredible 1999 speech really boils down to this one simple, powerful idea. As an investor, it is your capital on the line.
You are the one taking all of the risk. And because of that, you have every right to demand your fair share of the return. The question you should always be asking is the one right here on this slide, show me the money. Because at the end of the day, it's yours.
All right, let's dive in. Today, we're going to dig into a really fascinating speech from 1999 that pulls back the curtain on the competitive edge of a true financial titan. We're going to find out how one company completely changed the game, not with flashy ads or anything like that, but with a simple, powerful, and honestly, pretty radical idea at its heart.
You know, to really get a handle on just how different this company was, you have to look at how people talked about them. Back in '99, Forbes magazine took a look at this firm and basically just threw up its hands. They called it not a business at all, a religion. I mean, think about that. This quote just perfectly sets up the mystery we're here to solve. What on earth was so strange, so different about this company's whole approach? And that really brings us to the big question, doesn't it? The mutual fund industry, it's usually all about advertising, big sales teams. You know the drill. So how did a company that did almost none of that become this absolute powerhouse? Forbes called it a freakish anomaly, something that just shouldn't have happened. So how did they do it? To figure this out, here's how we're going to break it all down. First, we'll see just how freakish their success really was. Then we'll get into the brutal math that's behind their entire philosophy. We'll look at the super simple product they championed, the revolutionary structure that made it all possible, how that structure shaped their entire strategy, and finally, we're going to end with a really big unanswered question.
Okay, first up, the freakish anomaly. And listen, you really can't overstate how much of a long shot Vanguard's success was. They started in 1974 as this tiny little player in a world of giants. But by 1999, they were the second largest mutual fund firm on the planet, managing a staggering $460 billion. And this slide, wow, it really just shows you their incredible dominance. By 1999, 60%, 6 out of every 10 new dollars flowing into no-load funds was going straight to Vanguard. But here's the craziest part. They did all of this while refusing to chase market share. They truly believed you had to earn it, not buy it. So what was earning them all this trust? Well, that trust was built on the first piece of their secret, and it's not some crazy complex financial magic. It's just simple, brutal math. It's all about the crushing, unavoidable impact that costs have on your money over time. It all starts with this one number, -3%. For the 15 years before this speech, the average equity fund lagged the total stock market by 3% every single year. Now, 3% might not sound like a total disaster, right? But the power of compounding turns what looks like a tiny leak into an absolute flood. Okay, let's put some real numbers to this to see what I mean. Picture two investors back in 1984. They both start with 10 grand. The first one just buys the whole market and gets a 16.7% return each year. The second one buys the average managed fund and gets 13.7%. That's the market return minus that 3% gap. So, after 15 years, what do you think the difference looks like? Any guesses? The difference is just staggering. The market investment grew to over $101,000. The average fund? Less than $69,000. The fund investor got only about 2/3 of the wealth they could have had. This is what the speaker calls the tyranny of compounding costs. It's math just slowly, silently eating your future returns. So where is that 3% vanishing to? Well, it's not really about managers being bad at picking stocks. Before you factor in costs, they're pretty average. No, the real problem is the costs themselves. You've got about 1.3% in operating expenses and then another 1% in transaction costs from all the buying and selling. Add it up, and that's a 2.3% drag that explains almost 80% of the entire performance gap. Okay, so if costs are the big bad guy in this story, what's the secret weapon you use to fight back? Well, that brings us to the next part of the secret, the simple index solution. The idea is so simple, it's almost revolutionary. If it's so expensive and so hard to beat the market, why not just own the market? And that's what an index fund is, plain and simple. There's no star manager trying to find the next hot stock. It's just a passive fund that buys and holds everything in an index, like the S&P 500. The goal isn't to be a genius, it's just to capture the market's return without all the expensive guesswork. So how does this super simple strategy actually do against the so-called experts? Well, the numbers are pretty brutal. Over that same 15-year stretch, only 1 out of every 24 actively managed funds actually managed to beat the plain old S&P 500 index. Just think about that. A success rate of only 4%. And hey, this isn't some fringe idea. This is a massive endorsement from maybe the most successful investor ever, Warren Buffett. His point is beautiful in its simplicity. By just taking the market's return with a low-cost index fund, the know-nothing investor can, and usually does, beat the professionals who are getting paid a fortune to try and fail. Okay, this all sounds so simple, right? So obvious. So why wasn't everybody and their brother doing it? To get that, we have to peel back one more layer. And this one is the most important of all. It's not just what Vanguard did, it's how they were able to do it. And the answer is in their truly revolutionary corporate structure. On one side, you've got the standard setup. A fund is run by a separate company whose goal is to make a profit for its owners. There's a built-in conflict of interest, right? But then you have Vanguard's mutual structure, and this is the game changer. Here, the funds themselves, which means the investors, own the management company. It's not there to make a profit. It's there to serve the funds at cost. So what does that structural difference actually mean in dollars and cents? It means this, 1%. Back then, the average fund charged 1.25% a year. Vanguard's average was just 0.25%. That 1% difference, that at-cost advantage, saved their investors $4.6 billion in a single year. That's more money in investors' pockets and less for the managers. But here's what's so important to get. This unique structure isn't just about saving a few bucks. It changes everything. It creates a completely different corporate DNA, a whole new set of values. Like the speaker says, strategy follows structure. Because Vanguard is owned by its investors, its entire strategy just naturally lines up with them. Think about it. They price things at cost, not whatever they can get away with. They treat their clients like owners because, well, they are. There's no pressure to gamble big to justify high fees. And why spend a ton on marketing? The whole focus shifts to long-term value, not chasing the latest fad. Now listen to this quote. It's a fiery call to action. To save our business from ruin, the first step must be to reduce expenses. It sounds like it could have been written yesterday by some reformer trying to fix the financial industry, right? But you're not going to believe where this quote actually comes from. And check this out. It turns out Vanguard's revolutionary idea wasn't new at all. Those words were from the 1880s. They were spoken by a man named Philander B. Armstrong, who founded a mutual insurance company. And the guy giving the speech in 1999, echoing those very words, that was his great-grandson, John Bogle, the founder of Vanguard. This wasn't just a business plan. It was a family crusade 4 generations in the making. Which brings us to our final section, and really the most obvious question you have to ask after hearing all of this. It's the unanswered challenge that still hangs over the entire industry today. The question is simple. If this mutual, low-cost, investor-owned setup is so much better for clients, and it was gobbling up 60% of all the new money, why didn't everyone just copy it? Why is Vanguard still a freakish anomaly? Well, the answer, according to our source, is as simple as it is damning. For a traditional company to switch to a low-cost model and give their investors a fair shake, they would have to destroy the profitability of their own management companies. They are trapped by a structure that forces them to put their own profits ahead of their clients' returns. It's as simple as that. And that's where we'll leave it, with this final thought. In an industry obsessed with complicated strategies and flashy marketing, what if the greatest, most powerful competitive advantage of all isn't a secret formula? What if it's simply a better structure, one that perfectly aligns your success with your customer's success? Something to think about. Thanks for tuning in. All right, let's dive into a paradox that's hiding in plain sight, right at the heart of our financial system. It's all about a term you've probably heard a million times, shareholder value. But what's fascinating is how the very institutions that are supposed to be its protectors might in fact be its biggest problem. And to kick things off, just listen to this zinger from Warren Buffett. He's talking about mutual fund directors here. Some of the most powerful people in the world of finance. So why on earth would he call them cocker spaniels instead of the fierce watchdogs they claim to be? Well, to figure that out, we first need to understand how this whole system is supposed to work in the first place. So, here's how we're going to unravel this mystery. First, we'll pin down what that mission of shareholder value is really all about. Then, we'll get into the tricky business of how you even measure it.
We'll meet these so-called watchdogs, investigate why they've been so quiet, and then, and this is the key, we're going to turn the mirror on them before we finally look at a possible way forward. Okay, let's start with the absolute bedrock principle of modern business. For a long, long time, the #1 mission for any big publicly traded company has been crystal clear. Your job is to create long-term economic value for the people who own the company, the shareholders. Everything else is built on this one core idea. So, what does shareholder value actually mean in plain English? Well, it's not just about making a profit. It's about earning a return on the money invested in the company that's better than what those investors could have earned somewhere else with similar risk. To put it simply, if you put your money into a company, you expect them to do better with it than you could have by just buying a simple, boring market index fund. Right. But this immediately brings up a huge question. If creating value is the goal, how do you measure it? Do you just look at the stock price bouncing around every day? Or do you zoom out and focus on the fundamental, long-term health of the actual business? This difference, this tension, is where things start to get really, really interesting. And just look at this. This is where you can see that gap between perception and reality just blown wide open. In the 1970s, the actual businesses themselves were doing great, a fundamental return of over 13%. But because investors were so gloomy, the stock market return was terrible, only about 6%. Then, in the 80s, the whole thing flipped on its head. The businesses were actually doing a little worse, fundamentally. But market optimism was through the roof, and it drove returns to an incredible 17.6%. This just goes to show that the market's mood can totally overpower what a company is actually doing, even over a whole decade. And this is exactly what the legendary economist John Maynard Keynes was talking about decades ago. This data proves his point. It shows that the stock market, especially in the short run, can be driven more by emotion, by mass psychology, than by the real, tangible value that businesses are creating. The long-term fundamentals are what really matter. But the day-to-day market, it's just full of noise. So if the market can get so disconnected from what's really happening, who's supposed to be holding these companies accountable? Who's making sure they stay focused on that long-term mission? Well, this is where a powerful new force stepped onto the scene, the institutional investor. To really appreciate just how massive this change was, let's rewind the clock to the 1950s. Back then, big institutions like pension funds and mutual funds were tiny fish in a big pond. They owned less than 5% of all stocks. The market was almost completely dominated by regular, individual investors like you and me. Okay, now fast forward to 1998. Which is the time period our source material is focused on. And wow, the entire landscape has been redrawn. Institutional investors now own over 70% of the entire stock market. The power has shifted from millions of separate individuals to just a handful of massive firms. Firms that, in theory, could act as incredibly powerful watchdogs for all of us. And when you look inside this powerful new group, one player stands head and shoulders above the rest. By the late 90s, mutual funds had become the single biggest piece of the pie, controlling a whopping 41% of all institutional money. This made them, without a doubt, the most powerful potential watchdogs in all of corporate America. And this, right here, brings us to the central paradox of this whole story. If mutual funds own the most stock, and because of that had the most power to demand that companies focus on long-term value, then why were they so often the quietest ones in the room when it came to corporate governance? It just doesn't add up. Well, it turns out there are a few pretty big reasons for this silence. First, they were obsessed with the short term. The average fund only held a stock for a little over a year. I mean, why would you bother with the slow, hard work of improving a company if you're just going to sell it soon anyway? Second, good old-fashioned inertia. It just wasn't how things were done. But the third reason, that's the one that should really make you nervous, massive conflicts of interest. Think about it. A big mutual fund company might also manage the retirement plan for, say, Coca-Cola. Are they really going to risk that giant profitable contract by publicly criticizing Coke's CEO? Probably not. But, there might be an even deeper, more fundamental reason for their silence. It's summed up perfectly by that old saying, people who live in glass houses shouldn't throw stones. Maybe, just maybe, they were a little reluctant to criticize other people's businesses because their own house wasn't exactly in order. And this is where the story takes a huge turn. So, up to this point, we've been asking how well mutual funds hold corporations accountable. But now we have to flip the script and ask a much tougher question. Who's holding the mutual funds accountable? Are they actually creating value for their own shareholders? Okay, look at this comparison. Because the way mutual funds are set up is, well, it's kind of bizarre. In a normal company, the owners, that's the shareholders, they elect a board of directors to watch over the management team. Simple enough. But in a typical mutual fund, an outside management company creates the fund, and then that same manager gets to pick the fund's board of directors. And then those directors that the manager just appointed turn around and approve the fees that the manager pays itself. In effect, the manager hires its own boss. It's wild. And once again, Warren Buffett just nails the absurdity of it all. As he puts it, negotiating with oneself seldom produces a barroom brawl. Of course not. When a manager is basically negotiating fees with a board that it put in place, it's not a real negotiation. It's a massive built-in conflict of interest. So what's the real-world result of this strange system? Well, remember that very first principle we talked about? Creating value means earning more than your cost of capital. For a mutual fund, that cost of capital is just the return of the overall stock market. Well, get this. The cold, hard truth is that over the 15 years leading up to 1998, the average equity fund actually destroyed value. It underperformed the market by a shocking 2.25% every single year. This chart just makes that failure painfully obvious. Think of it this way. For every dollar the market earned for investors, the average mutual fund investor only took home about 85 cents. So where did the other 15 cents go? It's simple. Costs. High management fees, big marketing budgets, and way too much trading. It all got eaten up, dooming the average fund to fail the most basic test of creating value for its own owners. Okay, so if the traditional actively managed fund model seems so fundamentally broken, is there a better way? Is there an alternative? Well, the source material we're looking at points to a different approach, one that directly attacks those core problems of high costs and short-term thinking. And that alternative is called indexing. The idea is so simple. Instead of paying a manager a fortune to try and beat the market, an index fund just tries to be the market. It buys all the stocks in an index, like the S&P 500, and just holds on. This guarantees that you get the market's return, minus a tiny, tiny fee. It's automatically long-term, it's super low cost, and as you can see from the numbers, it was already starting to catch on in a big way by the late 90s. And this really brings us back to that powerful ancient phrase, physician, heal thyself. It just perfectly captures the core problem here. How can an entire industry go around demanding accountability and good governance from all of corporate America when its own structure is systematically failing its own shareholders? It's a profound hypocrisy at the heart of the system. And that, of course, brings us to today. This whole analysis was based on a speech from 1998, but the fundamental questions it raises are just as relevant now as they were then, maybe even more so. Yeah, indexing is huge now, but there are still trillions of dollars in high-cost active funds. So the challenge this leaves for all of us is this. Take a hard look at your own investments. Are they really set up to serve you, the owner, or are they designed first and foremost to serve the manager? Because that paradox of the watchdog that can't or won't watch itself, that's a problem that never truly goes away. Who really controls corporate America? I mean, really pulls the strings? It's a question that leads us to a fascinating mystery, one that's been hiding in plain sight for almost 50 years. It's a story about a bold prediction that crashed right into a very, very quiet reality. Okay, so picture this. It's 1951. A young, idealistic student predicts that these things called mutual funds are going to grow up to be powerful, responsible owners of corporate America. Now, fast forward nearly half a century to 1999, that same author looks back and, well, it didn't quite pan out. The power was there, for sure, but the strong voice he expected, it was barely a whisper. So what on earth happened? You have to remember, back in 1951, this was all just potential. Mutual funds were kind of small potatoes, They owned less than 3% of all U.S. stocks. Their influence was tiny, but the thinking was, hey, as they get bigger, their voice will get louder. It just made sense. And oh boy, did they get bigger. By 1999, mutual funds controlled a mind-blowing 35% of the stock market. 35%. They became by far the biggest, most powerful owners out there. They had all the muscle in the world, and yet they did nothing.
They were silent. And that right there is the mystery we're diving into. How did the most powerful owners become the most passive ones? All right, so here's our game plan. First, we're going to really unpack this paradox. Then we'll play detective and investigate the motives for all this silence. After that, we'll look at the actual cost of this inaction, see what forces might finally be shaking things up, and wrap up with a blueprint for how these owners can finally find their voice. So let's kick things off with this paradox. You've got this incredible concentration of ownership, of raw power, but the will, the spirit to actually act like an owner, it's just gone. You can just feel the disappointment in that quote, can't you? This isn't just about numbers on a spreadsheet for the author. It's about a broken promise. The expectation was that these funds would be champions for shareholders. Instead, they mostly just rubber stamp whatever corporate management wants. They totally failed to step up. So why? Why would these massive, powerful institutions choose to be so quiet? Well, when you start digging, the reasons are actually pretty clear. And honestly, they don't paint a very flattering picture of the industry. The first, and maybe the biggest reason, is that the whole game changed. The industry shifted from being about long-term investing to short-term speculation. Get this. Back in the 70s, a fund might hold on to its stocks for 5 years or more. By 1999, the portfolio turnover rate was a staggering 112%. They were basically selling and replacing their entire portfolio more than once a year. Let's put that into perspective. The average fund held a stock for just 326 days. Think about it. If you're only going to own a company for less than a year, are you really worried about its long-term strategy, its corporate governance, its 5-year plan? Heck no. You're just betting on where the stock price will be in a few months. That isn't ownership. It's just a high-stakes gamble. Okay, motive number 2 is a huge conflict of interest. At the end of the day, mutual fund companies are businesses. And you know who their biggest, most profitable customers are? Other giant corporations. They hire them to manage their massive 401k and pension plans. So are you really going to stand up in a shareholder meeting and challenge a CEO if you're trying to win his company's multi-million-dollar retirement account? Probably not. You don't bite the hand that feeds you. Right. The third reason is the classic excuse the industry loves to use. Oh, it's just too expensive. They argue that getting involved, actually doing the work of being an owner, researching issues, challenging management, would cost too much and hurt returns for their investors. But that excuse just completely falls apart when you look at the data. Take a look at TIAA-CREF, a huge retirement fund that's famous for being an active owner. They spend about $1 million a year on their governance program. Sounds like a lot, right? But it's just 0.003% of their assets. It's a rounding error. And the value they've created from it is in the hundreds of millions. So, the truth is, being a responsible owner is actually incredibly cheap. And the final motive? It's basically hypocrisy. You know the saying, people in glass houses shouldn't throw stones? Well, it's pretty hard to criticize another company's insane CEO pay or their weak board of directors when the mutual fund industry itself has its own really strange, often criticized structure. It's just a bad look. So what's the big deal? Who cares if these big funds are quiet? Well, this passivity has real-world consequences that affect the entire market. It creates a system that rewards illusions instead of reality, and that can make everyone's investments a lot more fragile. The biggest consequence is this thing called managed earnings. This is the game where companies, with Wall Street cheering them on, focus on just one thing: hitting that quarterly earnings number no matter what. It's not about building a better product or a stronger business. It's about financial engineering to make the numbers look like a perfectly smooth, straight line going up. It's a fantasy completely disconnected from the messy reality of running a business. And if you want to know just how accepted this is, get this story. At an American Express meeting, an analyst actually had the guts to question an accounting trick they used to hit their earnings target. The chairman didn't just defend it. He actually took a poll of all the Wall Street analysts in the room. And the result? A 10-to-1 vote in favor of managing the earnings. The very people whose job it is to uncover the truth about a company voted for the illusion instead. This shows you Wall Street doesn't just put up with this stuff, it actively demands it. So is this just how it's going to be forever? A market built on short-term thinking and financial tricks? Well, maybe not. There are a few powerful forces starting to bubble up that might just force these silent owners to finally start speaking. The first big force for change is the rise of the index fund. See, unlike an active manager who can just sell a stock they don't like,
An S&P 500 index fund has to own all 500 companies, the good, the bad, and the ugly. They are permanent owners. So for them, the only way to get better returns is to make the companies they own better. And that means they have to get involved in governance.
The second force is a ticking time bomb, executive pay. By 1999, the average CEO was making 419 times what the average worker made. That's up from about 40 times in 1980. This explosion was fueled by stock options, which can be a huge problem. They often reward executives just for a rising stock price, which can happen in a bull market even if the CEO is mediocre, instead of for building real long-term value. And Warren Buffett just nails the absurdity of it all here. For the longest time, companies didn't even have to count stock options as an expense. It was like free money, which massively inflated their reported profits and hid the true cost of executive pay. Buffett's just saying, come on, people, this is basic common sense. So with these pressures building, how can the funds actually start acting like the owners they are? Well, the author doesn't just point out the problem, he gives a clear, actionable plan for them to break their 50-year silence. The blueprint is pretty simple, with three main parts. First, the industry's own trade group should step up and lead the charge. If they won't, then step two is for the big players, the Vanguards, the Fidelities of the world, to start meeting and coordinating on their own. And third, even if just a handful of major long-term focused firms get together, they could create a powerful core of activists that everyone else would eventually have to listen to. You see, this whole story is about a huge shift in power without a shift in responsibility. But it ends with a question that brings it right back to all of us. Because if you own a mutual fund, an ETF, a 401k, you're part of this chain. The funds are the legal owners of corporate America, sure, but you are the ultimate owner of the funds. Which leaves us with one final, very important question to think about. What does that make you? You know, what if I told you that a speech from way back in 1991 could perfectly diagnose a problem that might be quietly eating away at your investments right now? Well, today we're digging into a really powerful critique of the mutual fund industry, and honestly, it's shocking how much of it still hits home. It all comes down to one big question. Who is this industry really working for? And this is the line that kicks everything off. It's this idea that we're not just talking about a few bad apples. We're talking about an entire industry, systematically losing its bearings. This quote really sets the stage for a deep dive into how an industry so successful could so profoundly lose its moral and its fiduciary compass. All right, so here's our roadmap for this explainer. Think of it as our investigative case file. First, we'll look at how the industry lost its way. Then, we'll examine the evidence, 5 key problems. We're going to zoom in on a particularly nasty fee, uncover the motive behind all of this, and finally, see if there's a way back. So here it is, the core accusation. The mutual fund industry went through a major identity crisis. It stopped being about the careful stewardship of your money and became this relentless, almost desperate chase for more assets. The main goal shifted to just getting bigger and more profitable, even if it came at the expense of the very investors it was supposed to be protecting. Okay, now for the evidence. The source material presents what it calls a litany of charges against the industry. So let's think of this section as our Exhibit A, the hard proof that something had gone seriously, seriously wrong. So here are the 5 main charges. First up, this bizarre paradox. The bigger the industry got, the more expensive it became for investors. Weird, right? Second, we're going to look at some truly appalling fee structures. Third, we'll get into the infamous 12B1 fee. Fourth, shareholder reports that were so dense and confusing they were basically useless. And finally, advertising that was all about reward, 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 and barely whispered about risk and cost. Let's tackle that first charge, the so-called paradox of scale. I mean, you can see on this timeline, the industry just exploded over these 40 years. Now, logically, you'd think that massive growth would lead to efficiencies, right? Economies of scale that would lower costs for you, the consumer. Well, let's just say the evidence tells a very, very different story. Okay, let's rewind the clock to 1951. The industry is pretty small, just $2.5 billion in assets. And back then, the average equity fund charged 0.72%. Just remember that number. That's our starting point. Now, let's jump forward 30 years to 1981. Assets have absolutely ballooned to $40 billion. So with all that scale, costs should have gone down, right? Nope. The average expense ratio actually climbed to 1.04%. It's a slow burn, for sure, but it is clearly heading in the wrong direction. But here's where it just gets wild. Look at what happens in just the next 10 years. By 1991, assets skyrocketed to $250 billion, and the average fee, it leaps to 1.45%. Get this, the rate of that increase was 4 times faster than it was in the previous 3 decades combined. More assets, it turns out, meant much, much higher costs for investors. And this chart, man, this just lays it all out, crystal clear. In that critical decade from 81 to 91, assets grew 5 times over, an incredible success story, but total industry expenses grew nearly 8 times over. So you gotta ask, where did all the economies of scale go? They just vanished. And that brings us right to charge number 2, these appalling fee structures. This table is from a real proxy statement at the time, and it is just, wow, look at this. The stated cost to actually run the fund stayed exactly the same, but they jacked up the fee anyway. That move generated an extra $1.6 million in revenue. And where'd that money go? Straight into the manager's pocket, pushing their profit margin from an already insane 85% up to 88%. All right, let's move on to the third charge. It's one the speech calls notorious, and for good reason. It's the 12B1 fee, and it's so important that it deserves its own spotlight. Let's call it Exhibit B. So, what is this notorious fee? Well, in a nutshell, a 12B1 fee lets a fund use your money to advertise itself and attract new investors. Yeah, you heard that right. You are literally paying for the company's marketing budget out of your own pocket. And the scale of this is just mind-boggling. In 1990 alone, these fees siphoned off over $1.2 billion from shareholder accounts. By the time this speech was given, a staggering 58% of all mutual funds had a 12B1 plan. This wasn't some rare exception, it had become the norm. You know, the speech points out that the disclosures for these fees were a total joke. An honest one would just say it plainly, right? This plan will cost you money and it will lower your returns. The fact that they didn't is a perfect example of who these fees really benefit. The manager, not you, the investor. So we've seen all this evidence. Rising costs, unfair fees, misleading reports. And you have to ask yourself, why? Why did all of this happen? Well, the source argues it all comes down to a single profound shift in how the industry saw itself. This is our Exhibit C, the motive. And here's the real aha moment. The industry started out as a trust service. It was grounded in this solemn fiduciary duty to manage other people's money prudently. But over time, it morphed into something more like a consumer products business, obsessed with market share, branding, and growth at any cost. The business aspect just completely swallowed the fiduciary aspect. Okay, so if the industry lost its way, is there a map to get it back on track? After laying out all the problems in the motive, the speech does offer a glimmer of hope, a path forward to put shareholders back where they belong, in the driver's seat. The speech identifies 3 key players who could turn the tide. First, the media, by shifting its focus from just flashy short-term performance to the stuff that really matters, like costs and fees. Second, regulators, like the SEC, by forcing funds to be way more transparent. But, and this is the big one, the speech is crystal clear. The buck stops with the independent directors on a fund's board. They are supposed to be the last line of defense for the investor. So how do we wrap all this up? What's the big takeaway? This speech boils everything we've talked about down to 3 simple, yet incredibly powerful questions. They were vital back in 1991, and they are just as crucial for any investor to be asking today. The first question just cuts right to the bone. Whose money is it that we manage? Is it the firm's money to be used as fuel for its own growth? Or is it the shareholders' money given to the firm in trust? And if you believe it is the shareholders' money, then the next question is unavoidable. Who represents these shareholders? In this whole complex structure, who is their advocate at the table? Who is fighting for their best interests? And that leads us to the final haunting question of the entire speech. The independent directors are supposed to be those advocates. So the question is simply, where are the independent directors? It's a question that has echoed through the decades, leaving us all with a critical thought to ponder. Who really is watching out for your money? It's pretty incredible to think that one of the biggest revolutions in finance was kicked off by a guy who got, well, publicly and unceremoniously fired from his job. It's this amazing story of how failure, fate, and a stubborn, almost religious belief in a simple idea could totally upend an entire industry. Today, we're diving into the improbable, unbelievable story of how Vanguard came to be, and we'll do it mostly through the words of its legendary founder, John Bogle.
All right, so here's the game plan. We're going to start with the choice that set everything in motion, this idea of taking a different path. Then we'll see how that choice led our founder through this wild ordeal of incredible luck and total failure, which, believe it or not, gave birth to a radical experiment. From there, we'll break down the fundamental problem this whole experiment was built to solve before we get to the two legendary innovations and the unwavering philosophy that literally changed investing forever. So where does a story like this even begin? Well, it all goes back to a single, powerful idea that got a hold of John Bogle early in his life. This idea of taking a different path, which he felt was perfectly captured by a famous poem he just loved to quote. Now, this wasn't just some poetic flair for him. No, Bogle said these words tell the entire story of Vanguard. It was a conscious, deliberate decision to take a road that, as he put it, no firm in this industry had ever taken before. And that's exactly what he did. He took a path no one else dared to. And wow, did it make all the difference. Okay, so let's get real about what these two paths actually were. The well-traveled road, the one everyone was on, was a mutual fund run by a separate, for-profit company. Think about that. That company's goal is to make a profit for itself, which creates this huge built-in conflict of interest. But Bogle's new path, the road less traveled, it was a company where the funds are literally controlled by their own shareholders. It operates solely for them. And get this, the seeds for this whole revolution, they were planted way back in his 1951 senior thesis at Princeton. I'm not kidding. He'd stumbled on this tiny but contentious mutual fund industry, and his conclusions were just shockingly ahead of their time. He said funds needed lower fees, that they couldn't realistically claim to beat the market, and that they had to be run honestly and economically. These weren't just some college kids' ideas. This was the blueprint for what would become Vanguard. Okay, so Bogle has these world-changing ideas. But how does he actually make them happen? Well, this is where the story gets really good. Because those academic ideas were about to get slammed by the brutal reality of the business world. Talk about a roller coaster. This timeline says it all. It starts with incredible luck. His thesis actually gets him hired by the legendary Walter Morgan. By 1965, he's the chosen heir. But then, young, ambitious, he makes a huge mistake. He pushes through a merger with these hotshot whiz kids, basically chasing performance, the very sin he would later preach against. The market crashes, the go-go era goes bust, and bam, January 1974, he's fired. This was a soul-crushing blow. He'd put everything into this company, and now he was out. But as you're about to see, it was the best thing that could have ever happened to him. And here it is, right from the man himself. His firing was a blessing in disguise. It was the necessary catalyst, the painful push he needed. The hiring got him in the door, but the firing is what forced him, finally, to take that road less traveled he always admired. It's the whole reason Vanguard even exists. So Bogle's out of a job. What's he do? He doesn't just walk away. No, he goes to the board of the funds themselves with this wild, unprecedented proposal, something he called the Vanguard experiment. And this right here, this is the secret sauce. This is the big idea. He basically said, hey funds, declare your independence from your manager. The new company would be owned by the very people who invested in it. So instead of a management company siphoning off profits, all the money goes back to the investors. It just completely flips the entire industry on its head. The company's only mission is to serve its owners, you, the investor, by operating at the absolute lowest cost possible. And you can't make this stuff up. Even the name was a stroke of luck. He needed a name, and one day an antique dealer stops by his office. Bogle buys some old prints, and the dealer just throws in the book they came from. Later, flipping through it, Bogle reads about Lord Nelson's famous victory at the Battle of the Nile, and the dispatch was sent from the deck of HMS Vanguard. It was perfect. Vanguard, at the forefront, leading the way. A fitting name for a company about to start a revolution. Okay, so this structure was revolutionary. We get that. But why was it so important? Well, to get that, we have to look at the problem Bogle was trying to solve. He believed there was this powerful, almost invisible enemy working against every single investor out there.
So, what's the big deal with trying to beat the market? Isn't that the whole point? Well, according to Bogle, it's like trying to beat the house at a casino. And we all know how that usually goes, right? He called it the croupier's game. Here's how it works. Before you factor in any costs at all, the market is a zero-sum game. If you add up all the wins and all the losses, you get the market's total return. So for every person who beats the market, someone else has to lose to the market. It's just simple math. But that's before the financial croupiers step in and start taking their cut. Once you subtract the costs of investing, the whole thing becomes a negative-sum game. As a group, investors are guaranteed to lose to the house. So who are these croupiers? Well, here's the lineup. You've got sales commissions, those hefty management fees, all the marketing and overhead, the hidden costs from funds buying and selling all the time, and the unnecessary taxes all that trading creates. Each one is taking a slice of your potential return. And how big is that slice? Bogle figured the average mutual fund was taking about 2.5% from investors every single year. Now, 2.5% might not sound like a lot, but it's like a tiny leak in a giant dam. Over a lifetime of investing, it's catastrophic. Okay, this slide right here, this is the one that should really make you sit up and pay attention. Let's say the market earns 12.5% over a long period. Well, the croupier's costs can eat up so much of that return that over 25 years, they can confiscate a staggering 68% of what the market gave you. So you, the investor, you took 100% of the risk, and you're left with less than a third of the profit. It's a rigged game, and Vanguard was created to change the rules. So the problem was crystal clear. The croupier's game was systematically ripping off investors. So what was the answer? Well, Bogle came up with two brilliant, almost ridiculously simple innovations. The first one is the legend, the index fund. Bogle literally just followed the math from his Princeton thesis. He manually calculated 30 years of data and found that the S&P 500 index beat the average fund by about 1.5% a year, which was, surprise, surprise, almost exactly what the industry was charging in costs. The solution was obvious. If you can't beat the market, just buy the market. Stop looking for the needle in the haystack. Just buy the whole haystack. And in 1975, the first index fund was born. His second big idea was just as brilliantly simple, but for bonds. Bogle just didn't believe any one manager could consistently guess which way interest rates were going to go. So he had this light bulb moment. Instead of one big fund where a manager makes all the calls, he created 3 separate funds with clearly defined time horizons. This was huge. It took the guesswork out of bond investing and gave control back to the shareholder. Look, Vanguard had these great products, no doubt, but that's not the whole story. At its heart, Vanguard was built on a simple, powerful set of principles, and it's that philosophy that has made all the difference. And you can see it right here, how it all connects. The guiding principle of simplicity led directly to the business strategy of low-cost funds. The principle of thrift and a deep sense of fiduciary duty, that's the legal and ethical duty to put your clients first, led to a company that operates at cost, with what Bogle called a Quaker-like discipline. These aren't just buzzwords on a poster. This is the DNA of the company. And he drew inspiration from history, from people like Pennsylvania's founder, William Penn. Bogle saw Penn's holy experiment in Pennsylvania as a test to see if a government founded on principle could work. And he saw his own Vanguard experiment in the exact same light, a test to see if a company built on principle could succeed in the cutthroat world of finance. And so he pressed on. He concluded his story by bringing it full circle, right back to Robert Frost. The journey down that road less traveled was long, and it was driven by something more than profit. It was driven by a mission, a series of promises to keep to millions of everyday investors. And that really is the story of Vanguard. It's a story that has so much to teach us about integrity, about perseverance, and about the incredible difference one person can make when they choose the road less traveled.
All right, so today we're going to dive into this incredible speech from 1975 that honestly, it reads more like a battle plan than a business plan. It's the story of how a massive corporate showdown gave birth to a financial giant and really changed the rules of investing forever. You see, this wasn't just about creating some new company. No, this was a full-on declaration of independence for investors.
Born of corporate conflict. I mean, listen to that opening line. It says it all, right? This was not some quiet, friendly startup. The company that we all know today as Vanguard, well, it was forged in the fire of a boardroom brawl, a power struggle so intense that it forced a total rethink of who the mutual fund industry was even supposed to be serving.
So let's set the scene. The year is 1974, and you gotta understand, we are not talking about some scrappy startup here. Our story kicks off inside a big, well-established mutual fund group, one of the major players on the financial stage at the time.
And just to put that into perspective, $1.7 billion back then, that was a huge amount of money. This wasn't some small-time operation. Their oldest fund, the Wellington Fund, had been around since 1928. These guys, they were the establishment. And, well, that establishment was about to get a major wake-up call.
So here's the spark that lit the whole fire. The company that managed the fund's investments upended its own CEO. But here's the kicker. That same guy was also the CEO of the mutual funds themselves. This one move created an instant, unavoidable conflict of interest, and it basically forced the fund's independent directors to step in and question the entire power structure.
Okay, so with this crisis blowing up, the independent directors, they stepped up and took control. And this is a key detail. They were the majority, 8 of the 11 board members. Their one and only focus now was protecting the people who actually own the funds, the shareholders, not the management company. They got their own lawyers and set off to find a whole new way of doing things.
And look, they didn't just wing it. They launched this massive effort called the Future Structure Study. We're talking a huge 5-volume analysis that looked at every single possibility. And the goal, is pretty simple on the surface, but also incredibly profound. Find a structure that would give investors the absolute best service for the lowest possible price. Period.
After all that research, the study came down to 3 really serious, and let's be honest, pretty radical choices. They could go for broke with mutualization and just buy the whole management company. They could take over distribution too. But in the end, they landed on option 2. The funds would run their own administration and just hire outside firms for investment advice. Nobody had ever done it like this before. But it was a revolution they felt they could actually pull off.
And right here, this is the heart of the whole experiment. The path they chose was all built on one single powerful idea: independence. We're not just talking about shuffling around some boxes on an org chart here. This was a fundamental shift in who held the power.
And ma'am, this quote just perfectly captures the new power dynamic. You see, before, the funds were basically creatures or captives. They were controlled by their management company. In this new world, the funds themselves would be the boss. They'd be the clients, free to hire and fire services as they saw fit, with only the shareholders' best interests at heart.
They didn't just throw the word independence around. They actually defined it, legally, in their SEC filing. This was no fuzzy, feel-good mission statement. It was a concrete legal framework that gave the funds the power to make their own calls, judge their vendors, and negotiate their own prices. The funds themselves were finally in the driver's seat.
So to make this independence a reality, the funds basically brought all of these core administrative jobs in-house. This meant building a brand new internal team of about 60 people, paid only by the funds. And their one and only job was to serve the shareholders, not some outside management company.
And the scale of this change, it was just massive. Just look at the numbers. The administrative costs the funds were now taking on, around $6.2 million. That was almost as much as the $6.5 million they were paying out for all their investment advice. They were really becoming their own, self-sufficient operation.
But listen, this wasn't just some philosophical debate about who's in charge. It had real, tangible benefits for the actual investors. This new setup immediately saved them $424,000 a year, and that savings went straight to the fund shareholders. From day one, lower costs were literally baked right into the DNA of this new model.
So to handle all this new work efficiently, across 11 different funds, mind you, they had to create a new company. They set up a service company, but, and this is the critical part, it was owned entirely by the funds themselves, and it ran as a nonprofit. Its only purpose was to provide services to the funds at cost.
Okay, so this new company needed a name, right? They couldn't just keep calling themselves the Wellington Group. That name, Wellington, was tied to the old guard, to the very management company they were breaking away from. It was confusing, and it just didn't fit the new independent structure. And so the name they chose was Vanguard, and they picked it for a really specific reason. To signal that this new, at-cost, shareholder-focused model wasn't just a new idea for them, they truly believed they were at the forefront, leading a massive change for the whole industry.
All right, so having a game-changing idea is one thing, but actually making it happen? That is a whole different ballgame. The road to launching this new concept was just a gauntlet of incredibly complex challenges. And just look at this timeline. It shows you how incredibly fast they moved. From the board's decision in July of '74 to the official launch on May 1st, '75, the whole thing took just 10 months. And get this, the SEC, the main financial watchdog, they approved this totally unprecedented application without asking for a single change. That's pretty wild.
And believe me, they hit some major roadblocks along the way. This whole thing was born from conflict, right? So of course the press was all over them. They were basically operating in a goldfish bowl. Internally, old relationships were turned upside down. People who were colleagues were now sitting on opposite sides of a negotiating table. And from a legal standpoint, they were in totally uncharted territory. The lawyers had no templates, no boilerplate to copy. They were writing the rulebook as they went.
So, you might be wondering, why are we still talking about some corporate shakeup from 1975? Well, because the legacy of this experiment created what you could call a new financial order. Let's really break down what that meant for everyone.
When you boil it all down, every single piece of this new model was designed to do one thing: benefit the shareholders. Think about it. For the first time, the investment advisor could actually be fired if they weren't performing. Costs now had to be negotiated fairly. Shareholder reports could be totally candid. The entire system was engineered from the ground up to eliminate conflicts of interest.
What the Vanguard experiment really did was create this new fork in the road for the entire mutual fund industry. You could stick with the traditional model, the Broad Street Group model, where you do everything in-house, or you could go down this new path, the Vanguard model, where the fund itself acts as the client and goes out and hires the best investment talent it can find.
And the speech wraps up with this fantastic quote from Bob Dylan. The point was pretty clear. The Vanguard experiment wasn't just happening in a bubble. It was a sign. The idea that things needed to change, that costs and loyalty to shareholders mattered, well, that idea was definitely in the air.
And so, that really leaves us with this big question. This Declaration of Independence from 1975 wasn't just the origin story of one company. It was this radical experiment that planted a really powerful seed. The idea that a financial company ought to be built from the ground up to serve its investors, and not the other way around. And that's a principle that is still shaking things up and reshaping the world of finance even today.
All right, so get this. Imagine trying to predict the future of the entire financial industry by using a gritty adventure novel. And not just any time, but over 50 years ago. That's exactly what we're diving into today. This absolutely remarkable speech that saw the dangerous rapids ahead for the world of finance and, what we can still learn from it.
The entire theme of the speech is anchored in this really powerful idea from James Dickey's novel Deliverance. See, it's not just about surviving danger, it's about being transformed by it. The whole argument is that by facing these huge, immense challenges, a business, and yeah, its leaders too, can actually achieve a kind of liberation, a deeper sense of purpose.
So, right away, this sets the stage for a forecast that's, it's unlike any other. I mean, forget about dry predictions and endless charts. This is a story. It's a warning. And it's a call to action all wrapped up in one powerful metaphor, a canoe trip into the vast unknown future of 1971.
Right. So the speaker argues that back in 1971, the money management industry was on this exact kind of journey. The entire sector was just hurtling down an unknown river, They're in a boat that feels solid enough, but it's not totally stable, and there's this very real sense of danger lurking just around the next bend.
But, before paddling off into that uncertain future, the speaker did something really smart. He first looked back at the treacherous waters they had just navigated. He took a hard look at the past 5 years, and we're talking a period of absolutely colossal change, to really understand how they ended up right there at that critical moment.
Okay, so here's the scorecard for their 5-year plan, and it's brutally honest. They missed their big goal for the flagship Wellington Fund. But, and this is the key part, that one failure is totally overshadowed by their other successes. When it came to diversifying into other funds and investment counseling, they didn't just meet their goals, they absolutely smashed them. It really tells a story of smart, strategic adaptation.
So look, it wasn't a perfect run, not by a long shot. But hitting 3 out of 4 of these huge, transformational goals, that was a really remarkable achievement. It basically proved the company had the right survival skills for the journey ahead. Things like initiative, flexibility, creativity, and being adaptable. They had learned how to handle rough waters.
To really get a sense of this, just look at 1966. The company was basically a one-product firm. A staggering 96% of its revenue came from a single source, the Wellington Fund. That's like putting all of your critical supplies in one canoe. I mean, talk about a risky strategy.
Okay, now fast forward just 5 years, and wow, the transformation is just stark. By 1971, the company was completely diversified. That one dominant fund, it now accounted for just 24% of revenue. It was balanced out by investment counseling and, get this, a majority coming from other new funds. So they hadn't just repaired their canoe, they'd built a much more resilient fleet for the river ahead.
All right, so with that look back complete, the speaker then turned his gaze downstream, looking toward the next 5 years. And that's when he identified two massive challenges, two dangerous sets of rapids that he believed the entire industry was about to face.
And these were the two great tests. First up, you've got professional responsibility. This was all about a total revolution in how performance would be measured and judged. And second, you've got fiduciary duty, a huge, dramatic shift in the legal and ethical obligations you owe to a client.
So let's break down that first set of rapids, professional responsibility. The speaker basically predicted that the whole era of money management being this mysterious art form, like some kind of financial alchemy, was coming to an end. The curtain was about to be pulled back, exposing the entire profession to the bright and frankly unforgiving light of data and hard numbers.
And what's amazing is how specific his predictions were. He saw a future where, 1, every single account's total return would be measured precisely. 2, those returns would then be adjusted for risk. 3, this would lead to a whole new standard, judging performance on a reward per unit of risk basis. And finally, 4, the entire investment process itself would come under intense scrutiny. I mean, in an era that was built on gut feelings and reputation, this was just nothing short of revolutionary.
Now, that second big challenge lurking downstream was fiduciary duty. The speaker saw the rise of this powerful new social force he actually called consumerism. And what he meant by that was that society was becoming more and more intolerant, not just of actual conflicts of interest, but of even the appearance of a conflict.
And this focus on fiduciary duty, well, it led directly to what the speaker called the jugular issue for the whole industry. We're talking about a conflict as old as time, one that cuts right to the very heart of the entire financial business model.
He framed it with this timeless biblical question. A man cannot serve two masters. Or, can he? Can a money manager, or really any professional, truly serve two masters at the same time? It's a question that forces a really uncomfortable look at who you are ultimately working for.
And to really hammer home that this wasn't a new problem, the speaker reached all the way back to 1934, to a warning from Supreme Court Justice Harlan Fiske Stone. Stone basically argued that forgetting this one simple principle that you can't serve two masters is the root cause of most major financial failures. It's just a timeless warning about divided loyalties.
And that brings us right to the core conflict. For a money management firm that's publicly traded, this creates an unavoidable tug-of-war. On one side, you've got your duty to the public stockholders, right? They demand relentless profit growth. But on the other side, you have this sacred fiduciary duty to your clients, who must always come first. And believe me, those two masters are not always pulling in the same direction. So, faced with this fundamental conflict, the speaker didn't just point out the problem and leave it at that. Nope. He proposed a radical redesign of the boat itself. He actually brainstormed some truly forward-thinking solutions to restructure the whole company and try to resolve this two masters dilemma.
His first radical idea was something called mutualization. Basically, the idea was that the funds themselves, and that means the clients by extension, would buy and own the company that manages their money. Think about it. That would completely eliminate the conflict of interest. The clients become the owners, and suddenly everyone's incentives are perfectly aligned. His second big idea was internalization. In this setup, the company would be owned entirely by its active executives. This would turn into a professional partnership, kind of like a law firm. And the main goal here was to get rid of that constant pressure for quarterly earnings growth, a pressure that the speaker believed was, and I'm quoting him here, antithetical to the responsible operation of a professional organization.
And this all brings us to the conclusion of the speech, and right back to that powerful opening metaphor. After laying out all the dangers of the river ahead, the new standards of professionalism, the deep ethical conflicts, the speaker finally explains what deliverance really means in this context.
He hammered home the urgency of his message with this incredible insight. You have to act before a crisis becomes obvious to everyone.
If you wait until the danger is clear and present, your options have already vanished. You're forced into bad decisions because there are no good choices left. That's what true leadership is. It's about seeing the rapids before you're already in them.
And this really brings us to the ultimate takeaway. True deliverance. It isn't just about reaching the end of the river safely. The real prize is the growth, the self-realization that comes from having the courage to navigate that peril head-on. It's about becoming stronger because of the challenges, not just in spite of them.
And so, the speaker ends his incredibly prescient 1971 speech with this single, provocative question. He leaves it to the audience, and now he leaves it to us to decide, is this just another adventure story, or does it capture a fundamental truth about the relationship between risk, responsibility, and the very nature of a professional life?
So, how can a U.S. president from the early 1900s and a Wall Street maverick from the late 20th century possibly be connected? Well, it turns out they share a single, powerful idea about what it means to leave a legacy, and it all starts with something called a lengthened shadow.
An institution is the lengthened shadow of one man. This line from Ralph Waldo Emerson is, well, it's everything for our story today. The idea is that the greatest institutions we have, the ones that really last, aren't just brick and mortar. They're the living, breathing embodiment of one person's vision, their character, their ideals.
And that brings us to our two guys, Woodrow Wilson, the 28th U.S. president, and John C. Bogle, the founder of Vanguard. Now, on the surface, they couldn't be more different. Different eras, different worlds, but what's so fascinating is that they were both driven by the exact same kind of stubborn idealism, and they both ended up building institutions that cast incredibly long shadows.
All right, so here's our roadmap. We're going to start with President Wilson's legacy and the idealism that was really his driving force. Then we'll jump over to John Bogle and see his almost parallel journey in the world of finance. We'll unpack his core philosophy, which is a wild ride. And finally, we'll ask the big question: whose shadow will ultimately endure?
Okay, first up, the president's shadow. Let's really dig into Woodrow Wilson's lasting impact.
I mean, just stop and think about this for a second. The Federal Reserve, probably the most powerful financial body in the entire world, that was Wilson. The residential college system at Princeton, which became a model for universities everywhere, yep, also Wilson. And the United Nations, that is the direct descendant of his League of Nations, an idea that actually failed in his lifetime and was a huge personal heartbreak for him. His shadow is everywhere.
So, what was the fuel in his engine? Well, it wasn't just politics. For Wilson, it was a moral crusade.
This quote just says it all, doesn't it? Wilson looked around at the Gilded Age and saw a handful of financiers who had a total stranglehold on credit. So creating the Federal Reserve wasn't just some boring economic adjustment. For him, it was a moral mission to make sure the financial system served the whole country, not just the wealthy elite.
And get this, he moved fast. In just 2 years, he created a central bank. He slashed tariffs to open up trade, and he beefed up the laws to fight monopolies. This wasn't just tweaking the system. This was a passionate, all-out effort to restore what he called a free field and no favor for every single American.
Now here's where it gets really interesting. His vision didn't just come from Adam Smith's famous book, The Wealth of Nations. No, Wilson was deeply moved by Smith's other book, The Theory of Moral Sentiments. And that book argues that a healthy society needs people to pull back on their own self-interest for the good of everyone else. So you see, Wilson's economic policies were a direct result of his moral code.
Okay, let's pivot. We're jumping forward a few decades to our second idealist, John Bogle. And you're not going to believe this, but an almost identical moral spark, one he found in a university library of all places, is what ignited a full-on financial revolution. While he was a student at Princeton back in 1949, Bogle wrote his senior thesis all about the mutual fund industry. And his conclusions were, well, they were completely radical for the time. He said funds should be about managing money, not about sales. He said costs had to be slashed. And, this was the big one, he said no fund could really claim it was going to beat the market averages. He basically wrote the blueprint for Vanguard decades before it even existed.
And when he finally got the chance to build Vanguard, he literally baked that idealism into its DNA. This part is so important. Vanguard is owned by its own funds, which means it's actually owned by you, the investors. It runs at cost, which gets rid of that massive conflict of interest where a company is trying to make money off of its own clients. Just like Wilson's Fed, this whole structure was a moral choice, designed to serve the people, not the other way around.
This unique setup allowed Bogle to champion a really simple but totally revolutionary idea about investing, and he explained it perfectly using a little metaphor from an ancient Greek poem.
So it all comes down to the fox versus the hedgehog. The financial fox is clever, right? He knows a lot of tricks. He's always trading, trying to outsmart the market. But the hedgehog, well, the hedgehog knows one big thing: just buy the entire market, a piece of every major American business, and then hold on to it forever at the absolute lowest cost possible.
So, which one wins? Well, the numbers don't lie. It's not even close. During this 17-year bull market that Bogle studied, if you put $10,000 into a typical Fox fund, you'd end up with about $136,000. Not bad. But that same 10 grand in the Hedgehog Index fund, it grew to $182,000. That's an extra $46,000 in the investor's pocket just by keeping costs down. Incredible.
And that staggering difference, it reveals the absolute heart of Bogle's lifelong crusade. It was a relentless conviction in one simple, powerful truth.
3 simple words. Bogle said them over and over and over again. Costs matter. He was convinced this was the single most important and most criminally ignored truth in the entire world of investing. Why? Because every single dollar you pay in fees is a dollar that isn't growing and compounding for your future.
And the long-term damage is just shocking. Look at this. Over a 25-year period, Bogle figured that for the average person, a stunning 45% of their potential market return, we're talking nearly half, was just gone, eaten up, confiscated by the fund's own costs.
Bogle was so relentless on this point, he actually compared himself to the old Roman senator Cato the Elder. You see, at the end of every single speech, no matter what it was about, Cato would say, "Carthago delenda est." Carthage must be destroyed. For Bogle, high costs were his Carthage. They were the enemy that had to be attacked relentlessly for the good of all investors. So let's bring it all home. How do these shadows last? We've seen these two idealists, Wilson and Bogle, who both fought for these radical ideas. And in both cases, their conviction was met with fierce, fierce resistance, only for history to prove them right in the end. It's pretty incredible when you look at it side by side. Both men saw their greatest, most idealistic projects fail at first. Wilson's League of Nations? Rejected. His quad plan for Princeton? Shot down. They were seen as tragedies in his lifetime. But today, we have the UN and those very residential colleges. It's the same exact story for Bogle. His index fund was literally mocked as being un-American. And today, it's a multi-trillion-dollar bedrock of modern investing.
And that, in the end, is what really defines a legacy. It's this steadfast commitment. It's not about whether you win or lose in the moment. That's secondary. What really matters is the fight itself, the passionate, idealistic pursuit of something you believe in. That is the real engine that creates a shadow that lasts for generations.
And that leaves all of us with the final question. Wilson and Bogle both showed us that an unwavering belief in a core set of principles can literally change the world. So it makes you stop and think about your own work, your own life, and ask, what principles are guiding the lengthened shadow that you hope to cast?
So here's a question for you. Can a truly idealistic vision not just survive, but actually win in the super competitive, cutthroat world of business? Well, today we're going to dive into a story that's part corporate history, part personal philosophy, and see how one company's radical idea to just serve its customers ended up putting it on the right side of history. And let's just start with the words of John C. Bogle himself. He's laying it all out for us right here. He frames this whole story as a battle, right? It's the idealistic vision of serving others versus the dog-eat-dog reality of American business. So how on earth did one company, Vanguard, actually pull it off? All right, here's our roadmap for this explainer. First, we're going to look at what made Vanguard so unbelievably different from the get-go. Then we'll dig into the philosophy that was kind of secretly driving its success. We'll map out the blueprint it followed, explore its ethical core, and then check out some crazy parallel ideas. And finally, we'll see why this whole approach didn't just work, it dominated.
Okay, let's kick things off with part 1, a different kind of company. Bogle always said that Vanguard's success came from marching to a different drummer. And to really get just how different their beat was, we first have to understand the incredible wave they were riding. Okay, just look at this chart. In about a quarter century, the entire mutual fund industry just exploded. It went from $50 billion to nearly $5 trillion. That is a 90-fold increase. I mean, outside of maybe the internet, this was pretty much the fastest growing industry in the US.
A rising tide was lifting all the boats, for sure. But Vanguard's boat wasn't just lifted by the tide, it was launched into the stratosphere. In that same period, their assets grew from $1.4 billion to $400 billion. That's a nearly 300-fold increase. It just blew the industry's growth out of the water. So the key here is, this was not just luck. Something was fundamentally different about what they were doing. And here it is. This slide is basically the secret sauce. The conventional model is just built on this massive conflict of interest, right? It's trying to serve two different masters, the outside company that owns and manages the funds and the actual shareholders who put their money in them. Vanguard just completely flipped that on its head. They said, nope, we're going to serve only one master, the shareholder. And they did it by making the shareholders the owners. This one little change is the key to everything. It shows you what happens when you perfectly align your interests with your customers.
Okay, let's move on to part 2 and see where this idea really comes from, the servant as leader. Because that structural change, as brilliant as it was, wasn't just some clever business school tactic. Turns out, it was the accidental embodiment of this super powerful philosophy that Bogle wouldn't even learn about for years. So the story of this philosophy actually starts way before Vanguard, with a guy named Robert K. Greenleaf. Back in college, he was inspired to try and change big institutions for the better, from the inside. He spent his whole career at AT&T, but it was after he retired that he finally put his life's work down on paper, in this essay that would kind of quietly start a revolution. So what in the world is servant leadership? It's actually a pretty simple but really profound idea. It says that real leadership starts with a natural desire to serve, to help people, to lift them up. The ambition to lead comes second. It's all about putting the well-being of others first. Now here is the wild part. Bogle started Vanguard in 1974. He had never even heard of Greenleaf's work. It wasn't until the early 80s that he finally read it, and he said he was just thunderstruck. He felt like Greenleaf was speaking directly to him, like he was finally giving him the words, the philosophy, for what he had already built completely on instinct. And that brings us right to part 3, a blueprint for a model. Bogle realized that Vanguard, almost by accident, was a perfect match for Greenleaf's blueprint for what an ideal service-first institution should look like. Let's see how. So Greenleaf basically created a 4-part test for a truly great, service-oriented company. It needs a super clear goal, a different way of thinking about leadership, a very specific power structure, and a solid system of trustees. So let's put Vanguard to the test, cornerstone by cornerstone. First up, the goal. And Vanguard's goal was, well, it was huge. They wanted to transform the entire industry. How? By getting rid of that two masters problem once and for all. The shareholders would actually own the management company, and that company would operate at cost. That means all the profits that would normally go to some external owners were instead handed right back to the investors. And what does at cost actually mean in the real world? Well, it means this. At the time Bogle was talking about this, Vanguard's unique structure was saving its investors almost $3 billion every single year. This isn't just some small perk. It is the hard, cold proof that when you align your interests with your customers, you create massive real-world value for them. This one simple sentence just nails Greenleaf's third cornerstone, organization structure. Most companies say stuff like, treat your clients as if they were your owners. Bogle pointed out that for Vanguard, it was way easier. Their clients are their owners. Power and authority don't rest with the managers. They rest with the very people they're supposed to be serving. All right, moving on to part 4, foresight, caring, and vision. Because beyond the corporate structure, there's this deeper, more human layer that connects Bogle and Greenleaf. It's a belief about what really, truly motivates a leader. What's so cool about this quote is how Greenleaf connects two ideas we don't usually put together, foresight and caring. He's saying that foresight, the ability to see what's coming, is the #1 skill of a leader. But the reason for that foresight, the motivation behind it, has to be caring for other people. Caring is the foundation. It's the rock. And this perfectly explains Vanguard's entire history. They made all these bold moves that other companies thought were just insane. They got rid of sales commissions on their funds. They created the very first index fund, which was an idea that was literally mocked when it first came out. Bogle argued these weren't just business decisions, they were acts of caring, driven by the foresight that giving investors a fundamentally fairer deal was simply the right thing to do. Now,
for Part 5, Powerful Parallel Principles. And this is where the story gets almost spooky. We're going to look at 3 examples where Bogle and Greenleaf, who were working totally independently of each other, used almost the exact same language to talk about their deepest beliefs.
Okay, first up, initiative. Greenleaf said the essence of a leader is going out ahead to show the way. So where did the name Vanguard come from? A famous British naval ship, HMS Vanguard. And what was the motto on that ship's badge? You guessed it, leading the way. It's the same exact idea.
Second, let's talk about dreams. Greenleaf wrote that for anything great to happen, it must be a great dream. Now fast forward to Bogle's first ever speech to his tiny crew of 28 people back in 1975. The company's future was totally up in the air. What did he title that speech? The Impossible Dream. Both of them knew that huge changes start with a vision that seems just a little bit crazy.
And finally, perseverance. Greenleaf's advice was just so simple. If you know you're on the right path, just keep on going. And that is an almost perfect echo of what became Vanguard's most famous piece of advice to all its investors trying to survive a crazy market: stay the course. It's this shared belief in just sticking with it for the long haul. Okay, so this all brings us to our final section, Part 6, The Right Side of History. We've got this unique structure, we've got this powerful philosophy, but does any of it actually work in the real dog-eat-dog world?
Well, the numbers really speak for themselves. By the late 90s, Vanguard had swallowed up nearly a quarter of the entire market for funds that don't charge a sales commission. Think about that. 1 out of every $4 invested that way went to Vanguard. That's almost as much as their next 3 biggest competitors put together. Investors clearly saw the value, and they voted with their wallets.
And this is really the ultimate lesson here. Bogle became totally convinced that servant leadership isn't just some nice, fluffy ideal. He believed it's on the right side of where business history is going. And by extension, all those principles Vanguard was built on, serving the client first, operating at cost, daring to be different, all of that was on the right side of history too. You know, the Vanguard story is this incredible proof that an idealistic vision really can win, but it leaves all of us with a really big question to think about. In a world where every company is being pulled in a million different directions by shareholders, by employees, by customers, who should that company truly serve?
You know, in the world of investing, there's this battle that's been raging for decades. And it's not about stocks versus bonds, or even growth versus value. Nope. It's a battle of ideas. On one side, you've got complexity, cunning, and just constant action. And on the other, radical simplicity. It turns out this whole conflict, and a winning strategy for your own money, can be understood through a single, ancient riddle, the parable of the hedgehog and the fox.
And it really all boils down to this one line, a fragment from an ancient Greek poet written over 2,500 years ago. You see, the fox is clever, right? It's always darting from idea to idea, chasing every new opportunity. The hedgehog, well, it's a simple creature. When it's faced with any kind of threat, it does just one thing. It curls up into a spiky, impenetrable ball. One single strategy executed perfectly every single time. And in that simple observation lies this profound secret to success in the seemingly complex world of finance.
Okay, so let's translate this for the world of Wall Street. The fox? Well, that represents the vast majority of the investment industry. It's this belief that with enough cleverness, enough complexity, and enough hyperactivity, buying this, selling that, you can somehow outsmart the market. The hedgehog philosophy, on the other hand, is the total opposite. It's built on a simple, durable, and, passive idea. It doesn't try to outsmart anyone. It just relies on knowing one great, unshakable thing.
All right, so here's how we're going to break this down. First, we'll really set the stage with the hedgehog and the fox. Then, we're going to take a trip into the very cunning and very expensive world of the foxes. From there, we'll follow the unlikely, almost accidental journey of a modern-day hedgehog. After that, we'll finally uncover the one great thing, the hedgehog's winning strategy. And we'll wrap it all up by looking at why, in a world that worships complexity, simplicity is actually the most powerful strategy of all.
So, our story really kicks off with the ultimate financial hedgehog, a man by the name of John Bogle. He looked at the investment industry and saw it for what it was, a world totally dominated by clever foxes. And he set out on a mission, a real crusade, to change it all, armed with nothing more than one simple idea.
And look, this was never just about making a buck or starting a company. For 50 years, Bogle was driven by this one single goal, to make sure the average person,
The everyday citizen who's just trying to invest for retirement or for their kids' education gets a fair deal. He was convinced the industry was structured to enrich itself, not its clients, and he was absolutely determined to flip that entire equation on its head.
Now, to really appreciate the revolution Bogle started, you have to understand the empire he was up against. So let's step into the world of the financial foxes, the world of active investing that has, for so long, dominated Wall Street.
The whole Fox philosophy is built on this really compelling story, right? It says that investing is this dangerous, complicated jungle, and you absolutely need a brilliant, highly paid guide to get you through it. Their strategy is all about action, chasing the latest hot trends, using these super sophisticated models to predict the future, and trying to slyly time the market, getting in at the bottom and out at the top. It's a game of constant motion and perceived genius.
But here's the thing. All that action, all that supposed expertise, it comes with a huge price tag. When you actually add up all the obvious management fees, the hidden costs from constant trading, and the sales commissions, the typical Fox fund was costing investors around 3% of their money every single year. Bogle had a great name for this relentless drain. He called it the croupier's take. The house is cut from the casino table.
Now check this out. This is where you can see the absolutely devastating real-world impact of that cost. Let's take the historic bull market from 1982 to 1999. If you had just put $10,000 into a simple fund that just mirrored the overall market, the S&P 500, it would have grown to $194,000. But if you gave that same $10,000 to the average Fox fund manager, you'd end up with just $114,000. That's an $80,000 difference. That's a new car, a down payment on a house, just vanished into thin air, eaten up by costs and the Fox's failed attempts to be clever.
And if you think that's bad, just wait. When you stretch this out over a 50-year investing lifetime, the magic of compounding works against you, and the picture gets, it gets truly insane. The investor, that's you, the person who puts up 100% of the capital and takes 100% of the risk, ends up walking away with a measly 30% of the final return. The other 70%, it's been quietly siphoned off by the financial industry. The Foxes end up with the lion's share of your money.
So, if the system was so tilted, how did anyone ever break through? Well, it wasn't with a more complex algorithm or a bigger trading floor. The whole revolution began quietly, with a college student who just happened to stumble upon an idea by pure chance. This is the accidental journey of the hedgehog.
I mean, picture it. It's 1949 in the Princeton University Library. A young John Bogle is desperately searching for a topic for his senior economics thesis. He wanders into the periodicals section, picks up a recent issue of Fortune magazine, and just happens to open it to an article called Big Money in Boston. It was about the tiny, pretty obscure mutual fund industry. And in that one moment, a light bulb just went off. Bogle said it felt like a miracle. He had found his life's work right there. And that one moment, that one article, set in motion this incredible chain of events. In his 1951 thesis, he argued that for funds to truly serve investors, they had to be sold with no sales charges and run at minimal cost. A totally radical idea for the time. He then spent the next 2 decades rising through the ranks of an investment firm, only to get fired in 1974, after a power struggle. But that failure, it was the best thing that ever happened to him. Because from those ashes, he built Vanguard, and just 1 year later, launched his revolutionary idea on the world.
And this, right here, this was the core idea from his college paper that became the bedrock of his entire company. He believed a mutual fund has one job and one job only, to manage the money. All the other stuff, the fancy marketing, the sales pitches, the constant search for the next hot manager, that was all just noise, incidental nonsense that only served to distract from the mission and drain returns right out of the investor's pocket.
I mean, you really have to appreciate the sheer guts this took. Humiliated after being fired from the top job, the safe play would have been to just quietly find another executive position somewhere. But instead, Bogle took this massive risk. He doubled down on those idealistic principles he discovered as a 21-year-old student and created an entirely new type of company, Vanguard, designed to be the leader, the vanguard, for a new and much fairer way of investing.
So what was this earth-shattering idea? What was the hedgehog's one great thing that all the cunning foxes running Wall Street had either missed or, more likely, just willfully ignored? Well, it turned out to be a truth so simple and so obvious, it was basically hiding in plain sight.
Okay, get ready, because this is it. It's not some crazy theory, it's just simple, undeniable math. As a group,
All investors own the stock market. So as a group, their collective return has to be the market's return. But that's before you factor in costs. Once you subtract all the costs of playing the game, the fees, the trading expenses, the net return for investors as a group must, by mathematical necessity, be less than the market's return. The foxes can't beat the market as a group. The costs make it literally impossible.
And that brutal bit of math leads to a really powerful conclusion, right? If trying to beat the market is a loser's game, then just stop playing. Just buy the entire market and hold it forever, keeping your costs as microscopically low as you possibly can. This was the idea behind the world's first index fund in 1975. The industry of foxes, of course, just reacted with scorn and ridicule. They called it Bogle's folly, mocking the very idea of settling for average as somehow un-American.
Now, to actually make this low-cost dream a reality, Bogle came up with this totally brilliant corporate structure, unlike anything else on Wall Street. At Vanguard, the funds are owned by their shareholders, that's the investors, and then the funds in turn own the management company, Vanguard itself. What this means is there are no outside owners demanding profits. Vanguard is structured to operate at cost, kind of like a co-op. Every single penny of savings goes directly back to the investors through lower and lower fees. It's a system built for you, not for Wall Street.
Which brings us to our final, and maybe most powerful takeaway from all of this. In a financial world that just thrives on complexity and jargon, the Hedgehog proves that the simplest solution isn't just an alternative. It is, by far, the most effective one.
And hey, if you have any lingering doubts, just listen to who said this. That quote is from Warren Buffett, a man who became one of the richest people on earth by being the most cunning of all the stock-picking foxes. And yet, he has consistently said that for almost everyone else, the best path is the hedgehog's path. That is a massive endorsement from the one person you'd least expect to give it.
You know, what Bogle really did here was apply a classic philosophical principle to the world of money, Occam's razor. The idea is that when you're faced with competing solutions to a problem, you should just shave away all the unnecessary complexity and go with the simplest one that actually works. The index fund is the Occam's razor of investing. It shaves away the active managers, the predictions, the frantic trading, and the high fees, leaving behind just the pure, simple, and effective core. So, at the end of the day, the Hedgehog strategy is more than just a way to invest. It's a total mindset shift. You stop seeing yourself as a trader of little electronic symbols on a screen, and you start seeing yourself as a part owner of the greatest businesses in the country, and really, the world. Through a low-cost, all-market index fund, you own a tiny sliver of capitalism. And your only job is to just hold on tight and let those businesses do what they do best: innovate, grow, and create value over time. That isn't just a good strategy. It is the winning strategy.
And all of this leaves us with one final question to think about. We live in a culture that just worships complexity. We assume that smarter means more complicated, that harder problems must require harder solutions. But what if, at least when it comes to securing our financial future, the exact opposite is true? The story of the hedgehog and the fox really forces us to ask ourselves, in a world that sells us on cleverness, could the simplest idea truly be the most powerful and revolutionary one of all?
So what if the secret to one of the biggest success stories in modern finance wasn't some complex algorithm, but a simple quote from a 19th century novelist? Back in 1999, a speech was given that basically pulled back the curtain on a philosophy that completely reshaped investing forever. This is the story of how Vanguard built an absolute empire on the majesty of simplicity.
And just to wrap your head around how revolutionary this was, you only need to look at this one number. In just 25 years, Vanguard's assets, well, they didn't just grow, they exploded. A 500-fold increase. We're talking from $1 billion to $500 billion. That made it the fastest-growing firm in the entire industry. So the big question is, how on earth did they do it?
Well, founder John Bogle's answer was, believe it or not, incredibly simple. He said their staggering success had nothing to do with size or complexity. Nope. Instead, it was all about their unwavering commitment to the single profound idea from Tolstoy. He believed the company's real defining quality was just recognizing the majesty of simplicity. But you know, this whole philosophy, it wasn't born in a vacuum. It was a direct answer to a huge, fundamental problem that was plaguing every single investor. A deep flaw in the system that was systematically draining wealth from the very people who were taking all the risk. So what exactly is this problem?
It's not a lack of faith in the financial markets themselves. I mean, history shows they provide incredible returns over time. The real issue was a broken trust with the financial institutions, the very stewards who were supposed to be looking out for investors but were failing to deliver them their fair share.
And the scale of this problem was, well, it was just staggering. Over the 25 years leading up to this speech, the costs from fund management and marketing alone ate up a shocking 40% of the stock market's total profits. Just think about that for a second. Investors, you put up 100% of the capital, you took 100% of the risk, only to see nearly half the reward just siphoned off before it ever got to you.
The speech explains this with a brilliant analogy, the casino. Now, in theory, investing is a zero-sum game, where you try to beat the market. But in reality, you've got the croupiers, the managers, the brokers, the bankers, and they're all taking their cut right off the top. This croupier's rake turns the whole thing into a loser's game, where investors as a group are mathematically guaranteed to lose to the market itself. The house always wins.
So understanding the problem, that was one thing. But solving it, that required something truly radical. A complete and total rethinking of how the entire system was wired.
And the solution was really built on two groundbreaking innovations. First, this idea of a mutual structure, which just turned the traditional company on its head. It made the fund's shareholders the actual owners. That meant the company could operate at cost. And second, the index fund, a brilliantly simple, low-cost way to just own the entire market and capture nearly all of its returns.
And what this did was create this fundamental shift in incentives. See, a traditional manager, their goal is to maximize profits for their external owners, which of course means higher fees for you. But in a mutual structure, the goal is completely flipped. You want to minimize costs because the investors are the owners. It created a system that truly worked for investors, not one that was just sold to them.
But here's the thing. These weren't just clever business moves. Not at all. They were the real-world application of those three pillars from Tolstoy's quote: simplicity, goodness, and truth. These were the pillars of greatness.
All right, so the first pillar was simplicity. The winning formula wasn't some hidden, complicated secret. It was about having the uncanny ability to recognize the obvious, own a diversified portfolio, hold on to it for the long haul, and just keep your costs at rock bottom. It's an idea so simple, it's almost profound, right?
The second pillar was goodness. And in this context, goodness really just meant one thing: putting the investor first, period. While other firms were built to maximize their own profits through high fees, Vanguard's structure was built for a totally different purpose: to align its success directly with the success of its clients. The goal was simple: the greatest good for the greatest number of people.
And the final pillar was truth. You know, in an industry that's so often fueled by hype, truth was their most powerful marketing tool. Their strategy was clear, it was backed by academic evidence, and it was completely transparent. They could tell you exactly why and how their funds performed. At first, the idea of just owning the market seemed kind of ridiculous to a lot of people. But the data, the truth, well, it was on their side.
But this whole groundbreaking philosophy, it wasn't even the whole story. The final, critical piece of the puzzle wasn't about numbers or charts at all. It was about people. It was the human element.
Because beyond all the strategies and all the structures, the company's core philosophy was this deep focus on real people, on their hopes, their fears, and their financial futures. As Bogle put it, it was about service to human beings. It was about serving them, not just, managing their assets.
And this focus on humanity was put into practice through a really clear set of values. It meant treating millions of shareholders not as account numbers, but as individuals. It meant treating every single employee with that same respect. It meant building a culture of fairness and compassion, and living by a simple, powerful idea, the golden rule. That was the essence of true stewardship.
And all of this led the founder to a really powerful conclusion. He wasn't just confident in the business he had built, he was confident in the ideas themselves. He believed that when you combine a simple, powerful investment strategy with deep human values, you create something more than just a successful company. You create something that's not only enduring, but eternal.
So it leaves us with a pretty provocative question, doesn't it? In a world, an industry that constantly rewards complexity and secrecy, this whole story suggests a different path. What if the most powerful advantage of all isn't some hidden formula, but just having the courage to recognize and act on the obvious?
Today, we're diving into a really powerful commencement address that gets at one of the biggest questions we can ever ask ourselves. How do we actually measure a meaningful life?
It's a fascinating look at the choice between chasing stuff and building a life of real character. First, we'll see how this whole idea was sparked by a movie, of all things. Then we'll dig into this tension between possessions and principles. After that, we'll look at a real-world story of success that was actually born from failure, understand the debt we owe for our advantages, and then wrap it all up with a challenge for each of us. Okay, let's get into it.
So where does an idea this big even come from? You might think it's from some ancient philosophy book, right? But the inspiration for this entire speech, well, it was actually found in the dark of a movie theater. So the movie is called A Civil Action, and it's about this personal injury lawyer who, at the beginning, is pretty much all about the money. He takes on this massive case about deadly water pollution, and he's seeing dollar signs. This is it, the big one.
But here's the thing. As he gets deeper into the case, as he really connects with these families who've lost their kids, something starts to shift in him. The hunt for wealth gets totally replaced by this all-consuming search for justice. He puts his firm, his reputation, his entire future on the line, and in the end, he loses it all. And this is where it all comes to a head. The lawyer's in personal bankruptcy court, and the judge is just staring at his file, totally bewildered. This guy, who was once a high-flying attorney, has literally nothing left to his name but $14 and a portable radio. And that's when she asks him this incredible question. He has no things, but man, did he stand for something. And that's the central question the movie leaves you wrestling with, right? Do you look at his empty bank account and call him a failure? Or do you look at his actions, his relentless fight for a just cause, and see a completely different kind of success? That one question is the launchpad for this entire explainer. So, how does this question from a movie build into this huge critique of our modern values? Well, the speech takes that core dilemma and holds it up like a mirror to the way our society so often measures a life well lived. First, the speaker takes us way, way back, like 2,500 years back, to the Greek philosopher Protagoras. The classical idea was that humanity itself, our character, our values, our minds, is the ultimate ruler by which everything else should be judged. But the argument is that we flipped that ancient wisdom completely on its head. In our world today, we're getting dangerously close to letting our possessions, our things, become the main way we measure not just other people, but even ourselves. And this really lays out the two competing ways of looking at life. On one side, you have the easy trap, measuring life by bigger houses and fancier cars, a never-ending pile of things. But on the other side, you have the stuff that actually matters, the intangible stuff, standing for what you believe in, fighting for justice, showing compassion, and serving others. Now, it's one thing to talk about these ideas in theory, but the speaker then uses his own life as a kind of case study. And it's a story where a huge failure became the very key to unlocking a totally different kind of success. And here's the twist. The speaker is John Bogle, and he says the single greatest break of his entire career wasn't a promotion or a big win. It was getting fired. Can you believe that? He says that what looked like a total failure was the exact thing that put him on the path to create the Vanguard Group. Life is full of surprises, huh? He really identified with this definition of an entrepreneur from the economist Joseph Schumpeter. It suggests the real drive isn't about the rewards, the money, the fame, the things, but about that deep internal fire to fight for an idea, to win for the sake of the achievement itself. And that was the whole mission behind Vanguard. The purpose was never to build some massive financial empire or get ridiculously rich. The founding idea, which he actually first wrote about in his college thesis, was simple: create a company that served its investors with honesty and fairness. So by the time of this speech, Vanguard had $500 billion in assets. Now you see a number like that and you think, okay, that's the measure of success. But Bogle, he saw it completely differently. He just called them boxcar numbers, just giant, abstract things that for him didn't hold much real personal meaning. So if that $500 billion number is meaningless, then what does matter? Well, for Bogle, the true measures were completely different. How well are we actually serving the people who are our clients? What kind of opportunities are we creating for our employees? And what is the real value of our name and our reputation? Those were the real metrics of success. This way of thinking leads right into another really powerful theme, this idea that no success, however you measure it, is ever achieved all by yourself. We all owe a debt for the head start we've been given in life.
The core belief here is simple, but it's huge. Our lives are just profoundly shaped by things that are way beyond our own individual effort. We're all products of chance, of good breaks, of the people who helped us along the way, and of the society we just happen to be born into. He lists some of these blessings that so many of us take for granted, caring families, a good home, amazing teachers who dedicate their lives to helping us grow, and just the sheer luck of living in a country with so much opportunity. The point is, these advantages aren't just gifts to keep for ourselves. They create what he calls a solemn obligation to repay that debt by serving the common good. And that brings us to the conclusion, where all these big ideas get turned into a direct and very personal challenge. Now, it's our turn to choose how we're going to live. He shares this timeless quote from Ecclesiastes, and it's really just a powerful dose of humility. It's a reminder that, hey, even if you're the smartest, most talented person in the room, life has its own plans. Setbacks are going to come. Time and chance happen to all of us, and your true character is really revealed in how you keep going. This is it. This is the ultimate takeaway. The core idea of the entire speech boiled down to one simple, powerful, undeniable sentence. After all the stories and arguments, this is the truth we're left with. Your character, your integrity, your principles, that's the essence of you, and it will always, always be more valuable than any pile of stuff you can ever collect. And so we end up right back where we started, with that amazing question from the movie theater. Only now, it's not for a character in a film or for a graduating class. It's for you. It's for me. It's for all of us. By what things will you choose to measure your life? That's a powerful question to carry with you.
All right, let's dive into a story that's really about two hearts. One belonged to a 7-year-old boy. The other, it belonged to a titan of the financial world. It's this incredible tale of loss, a miraculous second chance, and, the invisible threads that connect all of us. We're going to explore a really powerful speech by the legendary investor John Bogle, and he called it Telltale Hearts.
So Bogle kicks things off by setting this fascinating stage. He promises a tale of two hearts, both beating, sure, but in chests that weren't their own just a few years earlier. He frames it like a modern miracle, a hook that just pulls you right in from the very first line.
So these are the two sides of our story. On one hand, you have a heart that was given, a gift of life born from an absolutely unimaginable tragedy. And on the other, a heart that was received, granting a second chance to an aging businessman whose life was, quite literally, on the line.
Let's begin with that first tale, the story of the heart that was given. This is the story of a young boy named Nicholas Green. His life was tragically cut short, but his legacy, well, it would become a symbol of hope for the entire world.
Nicholas was just 7 years old. He was this imaginative, sensitive American kid on a family vacation. He loved stories about heroes, used to dress up like Robin Hood. He was just a child full of life and promise. And it was on this trip, during what should have been a happy family memory, that everything changed.
Late one night, on a dark Italian highway, the unthinkable happened. The family's car was attacked, chased, and shot at by highway thugs. When they finally escaped the terror, they discovered an even deeper horror. Nicholas, who was asleep in the back seat, he wasn't moving. The next day, doctors delivered the worst news imaginable. A bullet was lodged at the base of his brain. Nicholas was gone.
Now, in a moment of just unimaginable grief, Nicholas's parents, Reg and Maggie Green, made a decision of just extraordinary grace. As his father Reg later wrote, one of them just turned to the other and asked about donating his organs. The answer was immediate. It was an act of nobility so profound it's honestly hard to even wrap your head around it. The impact of their decision was immediate and profound. Nicholas's organs saved or completely transformed the lives of 7 people across Italy. His heart went to a 15-year-old boy, his liver to a 19-year-old girl. His kidneys, pancreas cells, and corneas, they gave others the miracle of a second chance, a future they never would have had.
And this story, it just electrified the world. This act of American grace in a foreign land sparked a global conversation about organ donation. It became known as the Nicholas Effect, an awakening that inspired millions to become aware of the monumental good that can come from a gift like this.
His father, Reg, reflected on how donation gave them a sense of purpose in the face of such a random, senseless act of violence. It allowed them to have a say in the final outcome, turning a moment of pure tragedy into a triumph of the human spirit. Okay, so now let's flip the coin. We're going to turn to the second tale, the story of the heart that was received. And the man who received it was the narrator of this speech himself, John Bogle, the founder of Vanguard. And his journey to this moment, man, it was a battle that spanned decades.
You see, Bogle was born with a really rare genetic heart disease, and his fight began when he was just 30. For over 3 decades, he endured arrhythmias, cardiac arrests, multiple near-death experiences, all while building one of the largest investment companies in the world. But by 1992, the battle had reached its endgame. His only hope was a new heart.
By the summer of '95, his condition had become critical. I mean, he could barely climb a single flight of stairs. He was finally placed on the highest priority list, status A, and was admitted to the hospital on October 17, 1995, to begin his wait.
For 128 days, he waited. And this period, it paints an incredible picture of Bogle's character. A shareholder sent him a watch with this kind of punny inscription on it, "Still on watch." And get this, from his hospital bed, he continued to work on Vanguard's annual reports, all while waiting for a heart from a donor with a matching blood type. And then finally, at 2 a.m. on February 21st, 1996, the call came. His new heart had arrived. The next thing he remembers is waking up and hearing what he called the most wonderful words imaginable. A doctor told him, "Congratulations, you have a new heart, and it is young and strong."
His recovery was, well, it was nothing short of a miracle. He went through 32 heart biopsies, and every single one showed 0 signs of rejection. His body had just perfectly accepted this priceless gift. His daily pill count dropped from 55 all the way down to just 20, and he was finally able to live a full life again.
And what a life it was. He was back to being incredibly active, climbing mountains, sailing his boat, biking, and even getting back on the squash court. He was, in his own words, able to exercise to his new heart's content. The transformation was so complete it was almost comical. A year after his transplant, he was at a Princeton alumni event when another alumnus mistook him for his own son, asking how his father was doing after the surgery. Bogle absolutely loved it, replying, "Go ahead, make my day." And this, right here, is where the two stories converge. One of a heart given in tragedy, the other of a heart received in hope. Together, they deliver a single, incredibly powerful message about humanity.
Bogle learned his donor was a 26-year-old man, and he wonders, who's to say that this young man wasn't one of the millions inspired by the story of Nicholas Green? That the grace of the Green family didn't lead directly to this second act of generosity? It's a powerful, unspoken link between these two telltale hearts.
On Thanksgiving Day after his transplant, Bogle wrote a letter to his donor's family. In it, he expressed his profound gratitude, calling the gift not just a medical miracle, but a spiritual one. He was renewed, he wrote, in both body and in spirit. This whole experience gave Bogle a profound new clarity. When he speaks to other donor families, which has to be one of the hardest audiences imaginable, he cuts right to the heart of it all with one simple, powerful question: what truly matters in this life? And his answer is a universal truth. He tells them that all the things the world makes a big deal about, age, race, nationality, they don't really matter. What matters is living the best life we can. What matters is human kindness. And what matters is recognizing that donation is maybe the noblest deed a family can ever do. And so the two hearts have told their tales, one from a young boy whose death became a gift to the world, the other now beating in the chest of an older man given a second chance. And together, they reveal this majestic union of human nobility and incredible scientific miracles.
Bogle ends his speech with this beautiful, poetic line he borrowed from an essay he'd read. It's the perfect way to wrap up the entire story, a declaration that while one life ends, the spirit, the kindness, the very heart of that person can live on. The heart is dead, long live the heart.
Today, we're diving into a really powerful philosophy for getting through your career and, honestly, your life. It comes from a 1992 commencement address by John C. Bogle, the legendary founder of Vanguard. It's such a simple idea, but it has these huge implications for anyone who's trying to build lasting success. So let's get right into it.
So where does this powerful mantra even come from? You might think it's from some famous philosopher or a business guru, but nope. It's from the side of an old New England lobster boat. Seriously.
The boat belonged to the speaker's late uncle, a dedicated sailor whose vessel's name just perfectly captured the simple, rugged, and absolutely essential truth about navigating the choppy waters of life. Now, it's easy to hear that and just think it means pushing through the hard times. The stormy seas, the failures, the disasters. But the real genius here is that it also means pressing on regardless of the good times. The smooth sailing, the success, even the triumphs. It's a reminder to stay hungry and focused, especially when things are going great, because that's often when we're at our most vulnerable. All right, so here's the journey we're about to take. First, we're going to unpack the mantra itself. Then we'll look at what happens when giants stumble, and contrast that with an incredible story of persistence. After that, we'll dig into the founder's original blueprint. And finally, we'll wrap up by figuring out what all this means for your own path forward. Okay, first up, the core philosophy. What gives these three little words, press on regardless, so much power? Well, it's the idea that persistence is the one true constant you need for success. It's a mindset that gets you ready for the inevitable ups and downs, making sure that neither despair nor arrogance can ever knock you off your course. President Calvin Coolidge absolutely nailed this. He said, "Talent won't do it. The world is full of unsuccessful people with talent. Genius won't do it. Unrewarded genius is practically a cliché. Even education isn't enough. Only persistence and determination are, as he put it, omnipotent." This idea is really the bedrock of the whole press-on philosophy. And then Rudyard Kipling's poem If adds this incredibly important layer. He calls both triumph and disaster imposters. Why? Because neither one is permanent. They're just moments in time. This wisdom really expands the mantra, warning us not just against the despair of failure, but maybe even more importantly, against the dangerous complacency that comes with success. And this brings us to a really critical lesson. What happens when these massively successful organizations forget to press on? This is where we see just how devastating it can be to treat triumph like a finish line instead of just another mile marker on the journey. So this leads us to the big question. What happens when a company is at the absolute top of its game, gets a little too comfortable, a little too relaxed, and loses sight of its mission? What happens when it stops pressing on? Well, the answer, as we're about to see, is that it risks becoming a dinosaur. Just look at this list. It perfectly illustrates the point. In the early 90s, the absolute titans of American industry were faltering. IBM, once the gold standard, got blindsided. Citicorp, the biggest bank in the world, took a nosedive. General Motors just failed to take quality and competition seriously. And the list just keeps going. American Express, Travelers, Macy's, all of them tripped up by the arrogance that success can bring. And if you want to put a number on it, just look at General Motors. In a single year, 1991, their losses added up to an incredible 4.5 times billion dollars. That is the catastrophic price of complacency. That's what happens when you forget to press on, even when you're at the very top. And this really highlights a powerful paradox, right? So often, corporations stop pressing on at the very moment of their greatest triumph. They fail to adapt to change, they don't see the competition creeping up, and success itself plants the seeds of their downfall. Okay, so in stark contrast to that, let's look at the story of a small firm that was forced to press on. A firm that looked failure right in the eye and through just sheer determination pulled off one of the greatest turnarounds its industry has ever seen. This whole saga starts at a moment of total professional disaster. It's 1974, and the founder gets fired from his job as CEO of a big mutual fund firm. But out of that absolutely heartbreaking moment, he started something new, fired up with a whole different kind of enthusiasm, the determination to build something better. But success was a long, long way off. I mean, for 4 straight years, from 74 to 78, the firm was just bleeding money. More capital was being pulled out than was being put in month after month. The only thing that saved them was an improving stock market. They were truly pressing on through some seriously stormy seas. So what turned the tide? Well, it wasn't some complex, secret formula. It was a commitment to 3 almost distressingly simple ideas. First, keep costs at the absolute rock bottom to give investors the best returns. Second, serve those investors directly, no expensive sales force in the middle. And third, provide the highest quality of service possible. It was a strategy built on fundamental integrity, not on flash. And the result of just sticking to those principles? It was staggering. The firm went from a struggling $1.8 billion in assets to $83 billion, becoming the third largest mutual fund complex in the entire world. They pressed on through failure and were rewarded with a triumph that was just breathtaking. But where did these simple, powerful ideas even come from? Well, the answer is pretty incredible. It lies in the speaker's own college thesis, something he wrote at Princeton way back in 1951, decades before he even founded his company. What's so wild is that the entire blueprint was right there in his youthful writing. He argued that funds can't really claim to beat the market, that their number one job must be to their shareholders, that real growth would come from cutting fees, and that corporate influence should always be used for the investor's benefit. These weren't new ideas he came up with later. They were lifelong convictions. So what can we take away from all this for our own journeys? We've seen the danger of success and the incredible power of persistence. But there's one more piece to the puzzle, a kind of moral compass that decides whether our persistence leads to lasting value or to ruin. Back in the 1980s, an era of shocking excess, this quote basically became an anthem. It was spoken by a famous Wall Street arbitrager, later made famous in a movie, and it just captured the spirit of a time when greed wasn't seen as a bad thing, but as the very engine of progress. But here is the crucial context, the part of the story that often gets left out. The man who actually said those words was eventually convicted of securities fraud and spent years in a federal penitentiary. That one little fact completely reframes the entire philosophy, doesn't it? And this reveals the ultimate lesson. The 1980s taught us a really hard truth. Enduring success, the kind of success that lasts a lifetime, isn't built on greed. It's built on something way more powerful and resilient, unshakable integrity. That's the only foundation that will let you truly and honorably press on. So this is the ultimate takeaway. Through disaster and through triumph, when you are fired and when you are celebrated, when you are struggling and when you are succeeding, press on regardless. Look, the challenges of success and failure are not a matter of if, they're a matter of when. A new chapter will always follow the last. The most important question isn't what's going to happen to you, but how you're going to respond. The chapter ahead is yours to write. So, what will your story be?